U.S. stocks resume their winning Mondays. Live from Studio 2 at Bloomberg headquarters in New York, I'm Scarlett Fu.
And I'm Katie Greifeld. We're kicking you off to the closing bell here in the U.S. And with about 2 hours ago, you're actually looking at an S&P 500 at session highs right now. Still have a little bit of wood to chop before we get there, but the S&P 500 up by 1.2%. Big tech, too, also up. The NASDAQ 100 up by 1.1%, even though we are starting to see that sell-off in the bond market resume. You have 10-year Treasury yields up by about 5 basis points right now at 488 or so, below that 5% level that we just touched last week. And I also wanted to talk about crude really quickly here, Scarlett. Of course, I remember when we were talking about $90, $100 a barrel just a couple of weeks ago. Right now, crude extending its slide down by about 3.3% to under $83 per barrel.
Yeah, very volatile moves in the energy space. Also a truly epic week on the calendar. You've got Apple earnings, the jobs report, and policy decisions from 3 major central banks, including the Fed. But what may end up being the most consequential is the U.S. Treasury's quarterly refunding announcement that could send bond yields climbing. It is the government's new borrowing plan that will reveal just how much Uncle Sam needs to ramp up debt issuance to fund the widening budget deficit. And forget AI. Weight loss drug makers are the better bet. That's according to the majority of investors in a Bloomberg survey. They say Novo Nordisk, which makes Ozempic and reports earnings this week, is a more attractive investment opportunity than Nvidia. The backdrop here is that U.S. stocks, especially the Magnificent Seven, are seen as overvalued. And as such, most respondents see the NASDAQ 100 and S&P 500 posting losses for this quarter, which sets us up perfectly for how earnings estimates are now looking against this weaker equity backdrop. And Katie, you've got the numbers. What are they showing?
They're not good, Scarlett. You take a look at the equal-weighted S&P 500. You actually have earnings estimates for future quarters coming down. Of course, we're in the thick of earnings season right now for the third quarter, and hasn't been too pretty. You have seen a little bit of an uptick when it comes to profits, but you wouldn't necessarily know it looking again at the equal-weighted blended forward EPS. That has been coming down, and we're looking at the equal-weighted index here, which really strips out the power of big tech, and you can see in white that that index has really taken a beating. But even still, what we're seeing in the equal weight, in the market cap weight, you're starting to see investors try to call the bottom here. You're taking a look at CFTC positioning data right now. We had a really huge net short buildup in the S&P 500. That's flipped, Scarlett. Now we're back to a very small positive in the S&P 500 futures. So we'll see if some of these bottom buyers are rewarded or whether they're just setting themselves up for more pain.
All right. Great wrap up. So let's kick things off with Kuei Wynn, CIO of Equity Strategies over at Research Affiliates, to get her take on where we stand in the equity market with earnings feels like more than halfway through. Kuei, what is your take? Clearly, there's some extreme positioning. There's a lot of concentration risk in equity markets, but have the declines that we've seen brought valuations down to a somewhat more reasonable level?
So I think it depends on where you're looking at in the market. I mean, clearly what we've seen is a massive amount of concentration in terms of performance and now in terms of the broad indexes. So it's not just happening in the U.S., though. I mean, the U.S. has really come to dominate global stocks as well. So if you look at the global index, of the top 20 stocks, about 19 are U.S. companies. And the only one that's not a U.S. company is Taiwan Semiconductor. And so not only do you have a concentration in the U.S. market in particular, about half of those 20 stocks are in the tech or fintech ecosystem. So what you're seeing is a massive amount of concentration. And at the backdrop of geopolitical uncertainty and higher interest rates, that understandably leads to higher volatility. And so one of the problems we have is, are markets overpriced? Markets are only overpriced if they don't deliver the goods. And what we see is that when stocks are priced for perfection, anything less than perfect in terms of earnings results in outsized price repercussions. So a good example is Google. Beat earnings estimates, had great EPS, except that their cloud business wasn't as good as expected. A slight flaw, and they got severely punished. So we'll see. That said, I'm sorry, go ahead.
No. It's clear that the bar has been set a lot higher with the gains that we saw earlier this year. What does this mean, Kuei, for the prospect of a year-end rally that typically people look towards?
So first of all, I just want to say that downward revisions in estimates and earnings at this time of year are not that unusual. People always start the year with very, very lofty expectations. Reality sets in, and then you can have more realistic growth through the end of the year. If you look outside of the Magnificent Seven, you actually find some stocks that are very reasonably valued. So if you look at a value-oriented index, such as our fundamental index, the Research Affiliates Fundamental U.S. Index, you'll find multiples of around 14 times earnings compared to 20-ish for the S&P. So it just depends on where you're looking. And with volatility this high, it usually portends room for a rebound going into the end of the year.
Wait, what do conversations with clients sound like? Because, of course, if you look at value indexes, to your point, maybe you'll find some bargains there, but you take a look at fund flows, you take a look at performance. When you see big tech reassert itself, that becomes a very painful trade. It just feels like, in general, investors are hesitant to go too heavily into it. So how do you sort of advise your clients that now's the time?
We don't advise our clients to go on one side of the boat versus the other. I mean, I think that a good portfolio is really relatively balanced between value and growth. I think what happened leading into 2019, 2020 was everybody piled out of value into growth, and many people missed the opportunity to rebalance into value. So our message is not necessarily buy lots and lots of value, but that value really has a place in the portfolio. And if you miss the opportunity to get back into value in 2020, 2021, then now gives you a really, really great entry point.
And how do you think about the volatility that we're seeing in the fixed income markets and how that's translating over to equities? Because over the past several months, obviously, the bond market's volatility, it feels like it's really spilled over into every market, including equities. Do you look through that, or what signals, what takeaways do you take from that?
So higher interest rates and higher fixed income volatility keeps a damper on equity valuations. So it's not necessarily that valuations have to fall from this point. It's just that, unfortunately, they don't really have a lot of room to expand. And so what you really need to look for is, are the earnings going to come through? That will ultimately drive the equity returns. And so far what we're seeing is earnings are okay. They're not great. And so what we're seeing is sort of mediocre equity returns and a reset in terms of expectations. Having said that, it's not unusual for an equity market to correct about 10% in any given year. It doesn't necessarily portend, a market collapse or any sort of a crisis in that regard.
I like that summary. Okay, but not great earnings. Quay, really appreciate your joining us. Quay Wynn is CIO of Equity Strategies over at Research Affiliates. Coming up on the close, the Fed, the Bank of England, the Bank of Japan, all out with rate decisions this week. We'll get a preview of what to watch for.
Plus, AI regulation is one of the big topics as AXA releases its future risks report. We'll hear from our interview with the CEO at the Martin Trust Center for MIT Entrepreneurship.
And McDonald's tops estimates on higher prices. What happened to value meals, even as U.S. customer traffic dipping for the first time this year? We take a closer look at what this means for the broader economy. This is The Close on Bloomberg.
Season is here.
Tons going on, lots of earnings.
Beat wherever you look.
Bloomberg breaks the numbers first.
It's a tale of two earnings. Results from Goldman Sachs, Bank of America, and Morgan Stanley.
Netflix is out, guys.
With exclusive expert analysis.
Recovery is underway.
They crushed it. It was one of their best quarters ever.
This is a story all about pricing power.
We're going to make more money. We're going to make more money. And we're going to make more money.
We're making bank. And I think that is what we can take away.
Bloomberg Television and Radio. Context changes everything.
AXA has released its 10th Future Risks Report, and the CEO discussed key factors, including climate and concerns, of course, around AI. He spoke with our own Romain Bostic at the Martin Trust Center for MIT Entrepreneurship in Cambridge, Massachusetts.
Climate risk has, apart from the year 2020, where we were all suffering from COVID, been the #1 risk. But over time, it has really become also more homogeneous across all segments of the populations in all countries. And what you obviously see that other risks, in particular geopolitical risks and technological risks, have really risen over the last couple of years, and I guess that will not be the end when I think about the 11th and the 12th edition.
What progress do you think that we've made in trying to address not only just climate change overall, but some of the targets that nations have set for themselves coming out of either the Paris agreements and some of the interim agreements since?
I think we've made a lot of progress in terms of conscience and readiness to tackle the issue. When you look at today the various strategies, in particular of companies in really wanting to tackle climate change, a lot has happened. I would say today we are still, unfortunately, in the space of listing the intentions. We're not yet in the space of a full-scale implementation of these transition strategies. And I think that's where we need to come next. And secondly, I believe that the governments also need to follow what the companies have done in terms of their own climate transition, which is also an area that needs to follow now.
Another interesting data point that came out of the report was around how people viewed artificial intelligence. There seemed to be a broad understanding that there is a tremendous amount of risk there. There also seemed to be a broad understanding that addressing that risk right now is woefully inadequate.
Yes, so I believe AI opens a new chapter for our societies, and when you look at it with entrepreneurial glasses, the entrepreneur always looks at what is the upside first, and then looks at what do I need to do to protect myself against the downside. I guess the public debate started this time very much around what are the downsides without ever talking about the upsides, and I think getting this balance right going forward seems to me very important.
Just this morning, before we began our conversation, the Biden administration here in the U.S. released basically, finally, their own guidelines for what they want to see with regards to AI protections. And this really only applies to what the government purchases, but it was pretty broad-based. It really did restrict a lot of what these companies can do, how they use that data, whether they are actually supporting broader initiatives with that data here. Do you think we need to see more of a global framework towards AI and its regulation rather than just individual countries putting things out?
It would be preferable to have a global framework. I mean, what we have done around the whole question on climate, we could actually also apply to have an international energy association also for AI. But given the context in which we are in, it will be very difficult to assume that it's going to happen now. So ideally, what we should do is certainly in certain blocks of governments that can work better together than others, make sure that we agree on principles that apply then to a larger range of countries.
And Romain is in our Boston bureau right now and joins us with more on his conversation. So it's interesting that he says the climate change discussions can form a framework. It took us decades to come to any kind of agreement on what to do about climate change.
I know. It was an interesting comment because, of course, he's talking about COP28, which is still kind of really more about resolving business from almost 2 decades ago. And this idea that we would have sort of enough stability, global stability, to create a broader framework for AI. I don't know. I mean, he's a pretty optimistic guy, I can tell you that, and he seems to think that we'll get it done. But right now, when you look at the geopolitical landscape, both the willpower that governments have and even to an extent the public, right now there's just very little confidence out there that we're prepared right now for what AI is going to bring.
And it's not just governments, too. I mean, you look at the details of this survey, and it's private companies as well. Just 16% of those experts saying that corporations are prepared for these risks.
Yeah, and I mean, we're talking about when you go through all the risks that are in this report, from climate change to geopolitical tensions to income inequality, the confidence that these survey respondents had in the ability for the government or corporations to mitigate these risks, it was the absolute lowest level of confidence when it came to AI. They basically just said, we're not prepared here. And, you know, this whole report kind of looks at the idea as sort of what sways us into a solution. And even the report was kind of inconclusive. And when I talked with Thomas about this, he was kind of very clear here that right now, there just is nothing out there. This is kind of everyone doing their own thing. There are going to be a lot of benefits, but the risks are very prevalent, and there still has not been a solution to address them.
What other risks did he cite beyond AI, beyond climate change? Because it's interesting that AI was obviously a concern, but it came in fourth overall among all the emerging risks.
Well, right above it, well, climate change was number one, but it's been number one more or less for the last 6 years, with the exception of the pandemic year where the pandemic took over. But then once you get beyond that, it's about the geopolitical tensions. It was also about cybersecurity, which was number three. And he said this is a big deal, and it kind of dovetails with AI as well. But this idea that you can sort of instigate, I guess, warfare, and I use that term very broadly, from, you know, the seat behind a computer. And there are a lot of companies and a lot of governments that really haven't adapted to this new reality.
All right, Romain, great interview. Appreciate your time, of course. That is Romain Bostic.
Yeah,
He's the
anything for you too. Yeah.
The co-anchor of The Close. He'll work his way back to New York City. But before he does, coming up on the program, big week ahead for central bank decisions. We'll break down what to expect next. This is The Close on Bloomberg.
So the Fed, the Bank of England, and the Bank of Japan are all out with rate decisions this week. Ludovic Subran, Allianz chief economist, joins us for more on what we can expect. And Ludovic, I suppose we kind of know what the BOJ is going to do. The Nikkei reported that the Central Bank of Japan will discuss a further tweaking of its yield curve control at its policy meeting tomorrow morning, and is likely to allow more flexibility. And we saw the yen surge as a result. How much do you trust this report?
I think it's pretty trustworthy, actually, and that's quite a surprise. You saw the yen and the bond, the 10-year bond, Japan 10-year bond actually moved to it because, you know, I think, you know, 25% of observers were actually waiting for this yield curve control band to expand. You know, I think some bankers actually reported the possibility of increasing the threshold to 1.5%, you know, after having had increased to 1%. So I think it's quite a huge move, right? And I think it's pretty interesting to see that the inflation reports in Japan were not good, but also the pressure. You know, the BOJ was basically doing QE yesterday. You know, they've been buying bonds like there's no tomorrow because they wanted to be within this range. So I think widening the range lowers the pressure, but we still have extremely low yen, and we still have, you know, it's a global tightening cycle. So Japan cannot defy gravity forever. And I think that's why markets get a bit excited about this news, even though it looks a bit far, because it has global effects on, you know, who's going to buy, you know, Eurobonds, for example, who's going to buy also into the rally in the US right after the sell-off we've seen. So I guess it's quite important to see what's happening in Japan right now, even though it looks quite far.
Yeah, Japanese fund flows of huge importance to the rest of the global markets. The BOJ introduced yield curve control back in 2016 as a way to, you know, cement control over monetary policy, keep its policy loose. How would you grade the effectiveness of it? Is it an A C+ effort?
You know, I think it's quite effective. Actually, it's a very cautionary tale for what could happen to maybe Europe going forward as fragmentation risks increase. You know, we see you guys look at the 5% US 10-year yield, but we look at the Italian 10-year BTP also at 5%. So everybody's looking also at this spread control mechanism that the ECB has been mentioning, the TPI, the transmission policy instrument, because that's maybe a cue for us to see what happened with Japan. And more globally, I think if we are serious about climate change and greening monetary policy, we may have to revert back to some form of yield control, because some of these investment needs to green the future, to green investment, may actually require yields to be under a certain level, so that the fiscal discipline on the real rates, which is already quite high, and we see that this debt servicing costs are increasing everywhere, could be lessened for the green investment. So whatever lessons we get from Japan, we should really take them seriously and also look at whether there are transferable to other parts of the world. But I would say for Japan, it worked. It was like a B plus.
Okay, a B plus. It's not bad. That's passing and then some. If we look over the totality of this week, of course, we have the Bank of Japan, we have the Fed, and if I can be honest with you, that's what I'm really focused on. Is that a mistake? Should I, also care about what we're going to potentially get out of Norway, elsewhere in the UK as well?
I think the UK is quite interesting because I think it's one of the central banks where it's a catch-22. I think the UK is one of the few countries in the world where there is a risk of a wage price spiral. We expect wage growth to be around 8%. We see, UK households taking credit like there's no tomorrow. The political, backdrop is also quite interesting because they are talking about elections in a year from now, but nothing is confirmed. So there are several policy changes that have been happening. So I think, the Bank of England is expected to keep rates unchanged, but that could be a mistake because there is, everywhere you look, there is this risk of overheating and there is this need maybe for the Bank of England to go one notch higher. So that could surprise market. But of course, talking about the US, because everybody has been very worried about the bond routes over the past couple of weeks, I think, the Fed is going to skip. We still believe at Allianz that the Fed may actually increase one more time in December. And of course, what is much more important now is to understand the equation with QT, the quantitative tightening pace, whatever fiscal deficit financing the Treasury needs, and Wednesday is this big refinancing report, so everybody's going to be looking also at this, and whether there could be some additional pressure on the 10-year yield of the U.S., right? Because in all models, I think everybody expects the 10-year to go back to 4% sometime, in the middle of next year. But it could be that there are some resistance factors because of this mismatch between supply and demand. Everybody's looking at that. So that's why whatever comes out of the Fed is actually important for the U.S., but also for the rest of the world, as you can imagine.
All right, Ludovic Subran, thank you so much, Allianz chief economist, for joining us, giving us a preview of the big central bank meetings. Katie, I love the fact that you threw the Bank of Norway in there, just for kicks.
I mean, they're on the schedule, so we do have to pay a little bit of attention. But between the Bank of Japan and the Fed, it's going to be a really important week. Also, it's not just the Fed. We also have the Treasury Department playing a starring role in this week's drama when we finally get that refunding announcement. You think back to the last refunding announcement. That was a surprise. They said that they were going to sell off more debt than had been expected. Things have been weird since. Yeah, things have been really weird since. This whole idea of there's too much supply, where's the marginal buyer? The buyers have all disappeared. We start off at the Bank of Japan. The central banks around the world, including from China and from Japan, maybe they're not soaking up as much as the Treasury supply as they did before. So who does that leave us with? Not the Fed. Not the Fed either. Yeah, they're out of the game, right? They're net sellers. Yeah. So the concept of there being a lack of price-insensitive buyers, it's a pretty scary thought, the day before Halloween. But we'll see what we actually get from the Treasury, what we get from the Fed, and all of that looks forward to the jobs report that we get on Friday. And the best part of it, the Treasury refunding announcement comes a couple of hours before the FOMC decision on Wednesday at 2 p.m. So just to make Wednesday extra interesting. Oh, yeah. Yeah. But in any case, take a look at these markets. You are looking at a rally on your hands. You take a look at the S&P 500 right now, Scarlett. I see it higher by about 1%, not quite session highs, but almost. So that correction was pretty short-lived in the S&P, right? I mean, it's not yet at 4,200, but that dip from the July 31st high to Friday was just over 10%. Now we're within that 10% band again. Well, it'll be fascinating to see how we settle up at the end of this very busy week. Much more markets coverage coming up. This is The Close on Bloomberg. This is the countdown to the close. Let's get a cross-asset check as we head towards the close of commodities markets. And Abigail Doolittle has been looking at the declines in the energy complex.
Yeah, for sure. And stocks may be higher, but overall, we do have the commodity index, the Bloomberg Commodity Index, down about 1%. And these are some of the biggest drags, really, to your point, Scarlett, here in the energy complex. New York crude down 3.7%. And it has something to do, in part, with the fact that German consumption is expected to drop in 2023 by about 90,000 barrels per day. We also also have the fact that the Middle East conflict remains somewhat limited amid Israel's push. So there are less concerns around supply constraints. Natural gas down 3.6% on milder weather. Wheat down for a second day, down 1.7%. And we have corn down about 0.5%, so some weakness for the grains. Now, relative to oil, we've been talking about the possibility of a big move. If we just check in on it quickly, it's probably likely. So overall, you can see oil out of June is in an uptrend, but this consolidation, all this volatility, the near-term uptrend has been broken. The longer-term, medium-term uptrend has been broken. There's an area of congestion here that suggests we could just see oil drop down toward, I don't know, let's call it 74 to 76 in pretty quick order, Scarlett.
Yeah, that would continue the volatility we've been seeing in oil prices ever since the start of the Israel-Hamas war. We'll keep an eye on that one. Thank you so much, Abigail. Now, in a week where the Fed's rate decision might be seen as the main event, the Treasury Department's new borrowing plans could actually steal the show. The quarterly refunding gives us a sense of the government's needs in the face of big deficits. So joining us now is Ira Jersey of Bloomberg Intelligence. And Ira, we know we get a lot of details on Wednesday, the same day as the Fed announcement, but actually we get a preview of everything today, right?
3 o'clock, in less than half an hour, we're going to get what the borrowing needs are for the next 2 quarters, or what, anyway, the Treasury Department thinks that they'll need. Remember, this is based on their own assumptions. Now, the fourth quarter, what's interesting about the current quarter that we're in now, it's actually usually pretty easy to forecast. It's really the first quarter of the year when you get all these tax receipts and also tax refunds that come in that winds up being pretty volatile and a little bit harder to forecast. But it's almost guaranteed that the government's going to continue to need to borrow a fair amount of money, and we're going to see increased issuance over the course of the next couple of months, at least.
So we'll get a few more details in less than 30 minutes time. And of course, once we get those details, we look forward to Wednesday and the refunding announcement that we'll get at 8:30 a.m. Eastern. What are you expecting in terms of the split of those new issues between the short end and the long end?
Yeah, so my expectation is that they'll issue more bills, a little bit more front end than the long end. And the reason is because the government wants to minimize its borrowing costs to the taxpayer. Now, you might say, well, because the yield curve is inverted, if they're issuing more 2-year notes and 3-year notes as opposed to 10s or 30s, isn't that actually increasing the amount of interest? Well, that's true in the near term, but if in 2 or 3 years from now, interest rates are lower, it means that the Treasury Department can refinance that debt at lower interest rates than what they can issue right now. So it's instead of locking in for 10 years or 30 years, they can do shorter term debt. So I think that they'll still probably grow everything throughout the curve, just a little more slowly in the long end than they did in August, which was one of the reasons why you saw a pretty decent sell-off the last time that they had the quarterly refunding.
Yeah, it feels like the Treasury, the U.S. government, is kind of like U.S. homeowners just waiting for the opportunity to refi on their mortgage or on their debt. What would this mean for Fitch and the other ratings companies that are looking at the U.S.'s credit rating and determining our credit worthiness?
Yeah, I think it's not going to change that much right now because we know that the deficits are going to stay reasonably high, 5-ish% of GDP and maybe a little bit more. But they will continue to look at it. Remember, Moody's is the only company right now that probably is going to have to make a decision whether or not the United States remains AAA rated. I suspect that maybe over time we'll get more rumblings of that. But the U.S., unlike say emerging market countries that have a lot of their debt in foreign currency, the U.S., like Japan and like England or the United Kingdom, they have all of their debt in their home currency. So the chances of default actually are very low in those situations because you don't have to worry about a currency crisis. Now, what it does do, though, however, is it reduces fiscal flexibility, right? So you have a ton of debt, you have to refinance that, you have to pay a lot of interest on that debt. So it doesn't give Congress a lot of wiggle room as to what they can do with the rest of the budget. And that, I think, is kind of the more concerning thing that will continue to happen as deficits are so large.
Well, Ira, I know you're going to be a busy man this week. Really appreciate your time today. Our thanks to Bloomberg's Ira Jersey. Now, still ahead, a supersized beat on sales and profits for McDonald's. We'll talk about what the future holds for the Golden Arches. That's up ahead. Stay tuned. This is The Close on Bloomberg. Time now for top calls. Look at some of the big movers on the back of analyst recommendations. And first up, we have AbbVie. Shares on the move after Barclays upgraded the stock to overweight. The analyst says that the drug maker's top line evolution over the next 12 to 18 months is clear, and he's confident on, quote, the timing of the trial. Shares currently up by about 2.8%. Next up, we have Chevron getting fueled up over at Bank of America with an upgrade to buy from neutral. The analyst says that the sell-off induced by the Hess deal is, quote, overdone, and that weakness provides a tactical opportunity to upgrade. You take a look at the shares right now, only up about 0.8%. And finally, we have a fun one. Truist, no longer sweet on Krispy Kreme, downgrading the donut company to hold from buy. This firm says that it's really struggling to recommend the stock given the unclear impact of GLP-1 weight loss drugs. They see the current overhang of these drugs on packaged food stocks lasting at least 6 months. Price target also chopped down to $13 from $20. Shares right now up about 0.5%, so managing through it. And those are some of our top calls. Now, another company facing the Ozempic threat, McDonald's, shaking it off in the third quarter with sales and profits that beat expectations thanks to higher prices. Let's get into it now with Nick Setyan. He is equity research analyst over at Wedbush. He has an outperform rating on the stock. And Nick, when you parse through the numbers, this really seems like it was about those higher prices. But how much pricing powers does the McDonald's have left?
Well, I mean, I think they're going to have to keep taking pricing, but I do think we're already starting to see the ceiling in terms of pricing. When you talk to franchisees, a lot of them are very hesitant to take any more prices for the rest of this year and probably into the first half of next year, particularly as guest counts have now turned negative. So I do think we're reaching that point where pricing becomes a lot more difficult to take.
We also take a look and you see that U.S. customer traffic dipped for the first time this year, slowest sales growth of the year. But how does McDonald's stack up against some of their peers when you think about the overall macroeconomic environment right now?
I mean, I think the QSR category is still the sweet spot. They continue to benefit from a trade down. McDonald's has been gaining so much share from everyone else that it's been very tough. Whether you think about the pizza guys or the fellows or the burger competitors, McDonald's has just been the primary share gainer. So it'll be interesting to see as guest counts have now turned negative, whether, some of those peers can actually retake some of this share. They're being a lot more promotional than McDonald's has been. So I think in the near term, there is an opportunity for some of the McDonald's competitors to actually retake a little bit of the share. So I actually think this is actually good news for some of the peers in the QSR segment, despite sort of guest counts being negative at McDonald's.
Right. Maybe there's a little bit of the halo effect fading here. McDonald's says, of course, it has raised prices, but it's done so in a strategic way in order to not to hurt comparable sales, those same-store sales that everyone pays attention to. Nick, any idea how they keep doing it strategically if they want to continue to raise prices, but do it, as they say, strategically, surgically?
Well, I think no one has a better view of their customer than McDonald's through their loyalty program. A lot of the value has been concentrated within loyalty, and so they don't have to do national, biggie bag types of deals. And so I think there's a way to increase some of the pricing on the loyalty, be a little bit less promotional on the loyalty app. That's a big way that they can potentially, increase prices, and then focus on the premium segment. That customer continues to be very healthy, so there is still some room to take pricing there.
Wait, who is the premium customer, and what does the premium customer buy?
Well, the premium chicken sandwiches, the premium burgers, for example, they kind of look at premium customers as above 75K household income. That lower income value customer is below 45K income. So I think there's still an opportunity above that 75K household income level.
All right, Nick, really great to catch up with you. Our thanks to Nick Setyan of Wedbush. And I mean, it's an interesting conversation to have. You think about the pricing power that McDonald's has relied on, as well as some of its peers. But as Nick was just walking us through, maybe some of that is coming to the upper limit.
I like what McDonald's CFO said, that they benefit from this affordability perception that allowed them to take market share. People feel like everything costs too much out there, so I want to, go budget a little bit with my, lunch, so I'm going to have McDonald's, even though though, you can't walk out of McDonald's with an extra value meal that doesn't cost at least $10 these days.
That was the point you made in the commercial break, which I thought was so good. I mean, we were talking about McDonald's versus some of its peers, and I said that's kind of fancy, but you think about the prices at McDonald's, it's not like it's exactly a bargain.
It's not cheaper than Smashburger or Shake Shack. And by the way, McDonald's fries are still top notch. I know we have a dispute here on that.
I know, no. More of a Burger King kind of gal.
Too crispy.
Yeah.
No flavor.
Well, you know,
all right.
in any case.
To be continued. Coming up, we're going to be joined by Adrienne Harris, Superintendent of the New York State Department of Financial Services, to discuss the current state of our banking system and whether we might expect, or she expects, additional shocks. This is The Close on Bloomberg. It is time now for our Wall Street Week Daily segment, and the host, David Weston, joins us now. David, who do you have?
Scarlett, thank you so much. Well, as you know, here in New York, it's all about the financial industry, and we're welcoming the woman who really oversees all the financial industry in the state of New York. She's Adrienne Harris. She's Superintendent of the New York State Department of Financial Services. So welcome back. It's really great to have you, Madam Superintendent. So let's start with the banks. There's a lot of things you have responsibility for. Let's start with the banks. Go back to last March. We had a sort of a hiccup in the system. That had to do with some interest rate risk. And we have some banks still to this day who have a lot of losses on their balance sheet with some of those longer term securities. How big a problem is that right now?
Well, I think the banking system now is very stable after the federal regulators took the actions they did with the systemic risk exception in March. But there's still lots of issues looming, as you mentioned, the interest rate risk and the unrealized losses. Certainly commercial real estate exposure is high on the minds of regulators all over the country. So the regional banking crisis, I think, is over. The banks are stabilized, but certainly we're mindful of other risks in the system.
You mentioned real estate, and obviously that's a big topic here in New York City. We have a lot of empty offices. And it's not clear what's going to happen with them. What about the time when those buildings need to get refinanced? Could we have another form of a crisis with the banks?
Yeah, it's an important issue. We look at our banks and their real estate exposure, whether it's office space, multifamily housing. I think regulators across the country and in Washington are looking at loan to value in the event of a refinance. And they're looking at diversification. They're looking at the segment overall to make sure that that risk is being managed proactively before these loans come due, and thinking about the new normal. What is this going to look like post-COVID? Are these office spaces going to be converted to housing, especially in big cities where there are housing shortages? So it's really is a very interesting policy area right now.
Hindsight's always 20/20, and there's no point in saying woulda, coulda, shoulda. At the same time, we can learn from what happened in the past. And what do you think regulators, including you, but not limited to you, might have learned from what we went through with Silicon Valley Bank and Signature Bank?
Yeah, I think there's so many learnings we've taken, and DFS, as well as other regulators, published reports about that. I think one is thinking about the modernization of regulation. When we think about the liquidity issues that these banks were facing and how fast the deposits fled, first from Silicon Valley Bank and then how that fire spread from California here to New York and other banks around the country, now understanding the digitization of money and how that impacts deposits. So, of course, the FDIC is looking at the insurance thresholds. But I spend a lot of time thinking about how we operationalize our regulations. If we're examining banks in a certain time frame, can we make that examination go faster without sacrificing rigor, give feedback to the institutions more quickly, and then hold them accountable for remediation so that that feedback loop becomes tighter and we don't have some of the issues that happened with SVB and Signature, where things were going unremediated for cycle after cycle after cycle with respect to examination. So there's a lot to be learned with respect to the rules in particular, but also how regulators are doing their job and how bank management's doing their job.
Another area where you really have taken a leadership position is on virtual assets, including crypto and things like that. There were regulations in place before you came in, but then you've really moved it forward fairly aggressively. At the same time, last time we talked about what about the feds? Where are the feds? And we thought we were going to get legislation, didn't happen. How much of that at this point is a little bit of a tug and pull about state versus federal? Because you've wanted parallel regulation, but it sounds like some people in Washington don't want that.
I think that's right. We are very keen to make sure that there is a federal regulator, a federal cop on the beat in the virtual asset space, because we've seen the risks and the dangers that that space presents. But we in New York have been leading in this space for a long time. The regulations were in place when I came into office, but now we've built a team of over 60 professionals devoted to this day in and day out. We've issued 9 pieces of guidance. We oversaw the unwinding of BUSD. So we're really leading here, and it'd be such a shame to lose that expertise and that experience. So just like we do on the banking side, we're eager to see parallel regulation between federal and state regulators, and that's reflected in some of the bills we've seen moving in Washington. I'm hopeful that they'll get done.
Some of the bills, but there are reports at least, and you can correct them if they're wrong, that some people in the White House would like to have preemption, essentially, have the feds take it over. Is that right? And if so, why are they doing that?
I think it's dangerous. I understand the desire to have one set of rules and avoid what some people think will be the race to the bottom. But you see in New York, what we have is the most rigorous set of rules and regulations around the world. There's no bigger crypto team than what we've built at DFS. There are no more rigorous regulations anywhere in the world than what we've had on the books. And I think it's important to preserve that.
Let me ask you the obvious question. If we had all the right regulations, could we have avoided FTX, as we're watching that trial go on just a few miles south of here?
Well, we did in New York, where FTX was not licensed to do business, and they made public that they were seeking a license from DFS, and they didn't get one. And in fact, their very business model was antithetical to the standards we have on the books. So if we had that nationwide, I think we would have been much better off.
You've been forward leading on cybersecurity. I understand you've been contemplating a possible regulation. Where does that stand right now? And what would it do if you did adopt it?
Yeah, well, New York has been leading in cybersecurity with the original cybersecurity reg that was promulgated in 2017, became the model for federal regulation and for other states across the country. We're now in the process of amending and updating that regulation, so that will come out soon. But we're focused on things like how we tailor the regulation for the diverse sets of businesses that we regulate, from insurance to banking to crypto. We're thinking about governance and incident response and business continuity, and of course ransomware, because this is a thing that didn't exist the way it does today 6 years ago when the reg was originally promulgated. So this is an update that we have to make. So I'm eager to get this out. You'll see it soon, but we're excited about the standards.
You've got a lot on your platter.
Yeah.
Do you have the resources you need to really address it? I mean, because right now, New York State doesn't have a lot of extra money floating around that I've heard about.
Well, we are assessment funded at DFS, so we cost the taxpayer nothing. We then refund about $500 million a year to the state in the form of restitution, reappropriated assessment money. So just in the 2 years that I've been at DFS, we've gotten $277 million back to New Yorkers in the form of restitution. So it's really a great investment where you don't have taxpayer money to fund the agency, but you get that much return. But any regulator will tell you that they need more bodies. In fact, in my 2 years at DFS, we've hired 350 people. We've promoted about 250 people, but that's just the beginning. We're still so short-staffed, and I'm looking forward to continue to build the agency because, as you said, we've got such a broad remit and so much we're responsible for.
Finally, Madam Superintendent, you've talked about New York State as being the world's financial capital.
Yeah.
Is it still today, after all that has happened? And what do you need to do to try to ensure it will be tomorrow?
I think it is, absolutely. And I was just hosting a delegation from the UK. I've hosted delegations from the UAE and similarly gone to their jurisdictions. New York still is the financial capital of the world, but we can't rest on our laurels. And the trick is having robust regulation that protects consumers and markets, but also that grows a healthy and thriving competitive marketplace. And I think both can be accomplished at the same time.
Well, that's the question. Is it a zero-sum game? The more regulation you have, the less people want to be here.
No, not at all. In fact, to the contrary, especially in crypto, where we've seen we have the most rigorous regulations on the books, and the demand for our licenses and charters only goes up and to the right because companies get that clarity from the regulator. And so it drives demand to be in the market.
Superintendent, thank you so much for coming back again. It's really great to have you. That's Adrienne Harris. She's superintendent of the New York Department of Financial Services. Tomorrow, we're going to talk with Pfizer CEO Albert Bourla about what comes next for the company who brought us the COVID vaccine. And then on Friday, we'll talk with former Chief White House economist Cecilia Rouse about the jobs numbers out that day. That's coming up at 6 p.m. Eastern Time on Wall Street Week on Friday.
All right, sounds like it'd be a great lineup of guests there. Thank you so much, David. Now, as we head towards the close, we've got just over an hour to go. You're looking at yields moving up, although they've given back a little bit of that advance. And of course, in about 4 minutes, we're going to get the Treasury refunding statement. There are details, of course, coming up later on in the week, but the number will come out at least.
The number will come out at 3 p.m. And of course, that informs what we're going to see at 8:30 a.m. on Wednesday morning in terms of the details of the Treasury's refunding announcement. So we'll see how some of these lines move right now. But you can see the S&P 500 stocks broadly having a good day. And Scarlett, I'll note that it's on the back of some pretty hefty volume. You take a look at the S&P 500 right now. Trading volume rather is about 10% higher than its 20-day average.
Yeah, that usually doesn't happen on up days. It's usually more the case when stocks are falling overall that you see a pickup in volume. But of course, this is a big week overall because in addition to the Treasury refunding announcement, we've got the FOMC. We've also got Apple earnings later this week.
That's true. Don't forget about earnings, of course. We think about the disappointment that we saw last week out of some of those, those big tech reports. They were a little bit of a bummer, so we'll see if that can rescue sentiment in this market.
All right, from New York, this is the close on Bloomberg. All right, we are waiting for the Treasury to come out with its net borrowing estimate for this current quarter. And of course, last time, Katie, they did this 3 months ago, it caused a lot of surprise in the markets.
And this is a market that is basically hanging on every word that we can get out of Treasury, that we can get out of the Fed. So we'll see what the reaction is. Of course, you remember the upset that we saw about 3 months ago when Treasury came out and said that they would actually borrow more than had been expected by markets. So we'll see the details, but this is a very nervous bond market.
Okay, we have just gotten the numbers, and the U.S. is cutting its quarterly borrowing estimate to $776 billion from previously $852 billion. Treasury says California receipts helped actually boost revenue. So it now is releasing its net borrowing estimate for the period. It sees $816 billion net borrowing for the January to March quarter as a result. So, Katie, this sounds like it needs to borrow less money than we previously thought.
And of course, it's still, we're seeing this get digested in the markets right now, but you're seeing a slight tick lower in yield, still much higher on the day if you take a look across the curve. But right now you can see that 10-year yields only up about 3 basis points. We had been up closer to 5-6 basis points. So a small move overall. We'll see how that develops. But yeah, interesting to finally get some of these details.
Yeah, and of course, on Wednesday in the morning, we will get the actual breakdown of how the Treasury is going to issue the debt, whether it's going to be in bills, whether it's going to be in bonds, and how much. And that obviously going to move markets, especially with the concern that there's a lot of supply to absorb. When you look at how the markets are trading overall, we have equities pretty much near their session highs. The Dow Industrial is doing the best here, up by more than 1.75%. The yen, of course, of big focus this week because there was a report that the BOJ will tweak its yield curve control, basically lift its cap on bond yields at tonight's meeting. Maybe the surprise is now gone because of this report.
We'll see, but let's get into some of these individual movers on the day because there's quite a few of them. I picked 3 gainers because why not? Western Digital, one of the big stories today, it's going to split into 2 separate publicly traded companies. Of course, it had been in talks to merge with the Japanese storage maker. Those fell apart. Now it's going to spin off its flash memory from its HDD unit. Shares up 7.5%. Let's also talk about SoFi. It came out, it raised its revenue forecast for 2023. It also said the deposits more than tripled from a year earlier. Third quarter total deposits jumped to $15.7 billion. The average analyst estimate had been for $14.9 billion. So some good news out of SoFi when it comes to the deposit story.
Yeah, but the stock it surged right at the open, and the gains have really faded over the last couple of hours here. So whenever I think of SoFi, I always think of the student loan refinancing, but it's so much more than that now.
It is so much more than that. Really a financial services company. I did want to talk about GM, of course, also coming to an agreement with the UAW. Still needs to be voted on, ratified, etc. But some progress there as well. GM shares only about 0.2% higher.
I guess everyone thought it was going to happen after Ford and Stellantis. It was kind of like it has no other choice at this point, right?
That's true.
All right, we're less than 1 hour away from the closing bell. We've got cross-platform coverage of today's top stories starting right now as we count you down to the close. This is The Close on Bloomberg.
Countdown to the close. Bloomberg's comprehensive cross-platform coverage ahead of the U.S. market close starts right now.
This is the countdown to the close. Scarlett Fu and Katie Greifeld here with you, joined now by our colleagues Carol Masser and Tim Stenovic, allowing us to welcome in full everyone across television, radio, YouTube, and originals. And we did get some headlines, Carol, just now about the U.S. cutting its quarterly borrowing estimates to $776 billion. We don't have to borrow as much as we thought we needed to.
God, all right, let's go out and spend some money then, I guess. No, it's interesting, right? It's basically a health check on the U.S. government and their spending. So it is interesting to hear that because, right, there was a little concern about maybe less revenues coming in recently. So that's an interesting number and something that we think about with the backdrop of a week that we are so much focused on the Fed. And I'm curious about Jay Powell, whether on Wednesday he'll make some comments about our fiscal situation with another deadline ticking.
I think he steers far away from that. He's like, that's Treasury. That's
going to be asked
us.
about it, though. You can pretty much bank on that.
Yeah, right? Because he's like got to look at this whole picture and wonder about, in terms of raising rates. And we think about what it costs for the government, basically, to service that debt. Having said that, all right, serious stuff aside, no more Treasury stuff.
Hey, this is serious.
Let's talk about the sweet stuff, if you will, because we did have Truist Securities coming out. They got a call on Krispy Kreme. Our Doug Krisner in the newsroom said we're going to call it sour cream because Truist basically downgrading it to hold from a buy rating. They cut the price target to $13 from $20. And this is, I feel like, a familiar refrain that we're hearing. They cited the uncertain impact of drugs known as those GLP-1s on packaged food snacks, Tim.
I think the uncertainty here is key. And the analysts come out and said, it's too early, Scarlett, to understand what the impact is actually going to be. But there is some concern that, if people are taking these GLP-1s on a widespread basis, then they will not eat as many donuts, I suppose. But I'm just going to take a step back and say, wait a second. We don't know how many people are going to be taking these.
Yeah.
We don't know how insurance is going to cover them. We don't know what they're going to do to consumer companies like Krispy Kreme. Seems like the market's kind of like overreacting. I want to say overreacting. I'm not.
But you said it.
I did. So. I know. I stopped myself though.
It's the uncertainty that no one knows about. I mean, maybe the weight loss drugs.
There's a lot of things that are uncertain.
Absolutely.
In this world.
Maybe the weight loss drugs will mean that if I want the donut, I'm going to have it, and then if I need to, I'll take the weight loss drugs afterwards.
And when it comes to the stock market, just sell now. Ask questions later. I wanted to talk about candy. This is tangentially related, but we talk about some of the risks for these food companies. You aren't necessarily seeing it reflected in the prices of candy right now. This is very much a story that's hitting as we talk about Halloween tomorrow. Consumers facing steep prices for candy this year because candy costs are surging. When you look at the price of cocoa, you look at the price of sugar. Of course, we've had a lot of weather events globally that is impacting crop prices. So looking at some steep costs for tomorrow night.
The big number here that really gets your attention, Americans expected to spend $3.6 billion on candy this year for Halloween, up from $3.1 billion. We are spending $500 million more this year than last year. Yes, because of higher prices, but that's a lot of candy.
Yeah, I actually went yesterday to the local store in my neighborhood to buy Halloween candy, and I was shocked to see how expensive it was. $32 for a bag of like Snickers and Kit Kats, and there's only 150 pieces in there.
Wow, that's
so
a nice
we're gonna run
man
out.
On the street.
We're gonna run out. The Stenovic house a little bit.
You're gonna have to ration.
I think we'll probably
kids
do is
on their costumes.
Take our toddler's candy, dump it in the bag.
All the Mounds and Almond Joy will be like redistributed again.
Exactly. Scarlett knows what I'm talking about.
It's time to put out a bowl of apples again.
We're not going to be them.
All right. You're not going to be known as that family.
Or raisins. Remember that? That's from our childhood.
Also.
Boxes of raisins.
Not interested. All right, guys. We're going to be back in less than an hour's time. Our cross-platform radio, TV, YouTube, and, of course, Bloomberg Originals. We do have some earnings coming after 4 Pinterest, so we'll be breaking them down as well. Join us at 4 p.m. Wall Street time.
All right, we continue the market's coverage here on The Close as we count you down towards the 4 p.m. close. This week's MLive Pulse survey results are out, and the survey asked, how would a 10-year Treasury rate above 5% impact the U.S. economy? And the majority, 53%, responded it would lead to a hard landing. 47% says the economy can manage. Let's get the perspective of our next guest, Ethan Devitt, Moneda's Chief Investment Officer. Ethan, thank you so much for joining us. What's your take on the 5% yield? We got there last week on the 10-year, but we came back a little pretty quickly after that. If we get to 5% again on the 10-year and stay there, what economic ramifications does that have?
I'm going to go with the 47% of your survey takers who said the U.S. economy will manage. As we can see, this economy is extremely resilient. We're seeing that through the consumers' ongoing spending. You just spoke about candy there. That's the ultimate discretionary expenditure, perhaps. And we've seen that in the resilience of the housing market with these mortgage rates, and we're seeing it in the company earnings. So yes, 5% is clearly a little bit of a milestone, a crossing of that milestone, and many market participants will never have seen that. However, if it's incrementally higher, not everyone is affected. Although I will say we are still seeing the transmission effect working its way through the economy. So we can say that the entire effect of these rate rises have yet been felt.
Yeah. And of course, at the top of the hour, we did get headlines from Treasury in which they cut their quarterly borrowing estimates to $776 billion from $852 billion previously. We'll get the breakdown of how the Treasury will issue that debt on Wednesday. How much nervous anticipation was there ahead of this number, Ethan?
I'd say quite a bit. We can see that movement around in treasuries. We've seen with really markets not knowing whether to be risk on or risk off or what bonds constitute. There's been a lot of murkiness around supply demand for bonds. And whereas much of this political wrangling doesn't usually disturb markets, it is raising the question about whether we can trust this government or any government to be prudent on the fiscal side. And that perhaps has been leading to some of the sell-off, although Janet Yellen had refuted a suggestion that the trading off of bonds was anything to do with confidence around the government's sovereignty and ability to pay. So I would say that perhaps was a little bit overstated. What was driving the bonds was really this movement in equity markets, the ongoing volatility that we're seeing, and just markets really looking to settle and understand how to cope with a higher for longer environment.
Well, talk to us a little bit about earnings, because heading into last week, which of course was the biggest week of earnings by market cap, there was a narrative that emerged that, okay, big tech is going to take the stage and it's going to really be the balm over this very stressed out market. That didn't seem to happen. When you look at the reports that we've gotten so far, the commentary from the C-suite, how are you feeling about the state of corporate America?
Very, very good. At least looking backwards, which is all the earnings do. We all knew that this earnings was going to be a robust set of period. It is a lagging indicator. The issue with tech is that the Magnificent Seven have been talked about so much now. It's almost been primed to fall from that precarious perch. And that's exactly what happened. There was a sense that this was too much concentration. The rest of the market had not participated. And although actually the tech numbers were good, investors were prone to find any little hole in that narrative, and that's what they did. We saw that with Google last week, perhaps an overreaction to their numbers. It is still all about AI. We know that is the new arms race now when it comes to tech. I'd be very interested to see how the Apple numbers are received. I suggest, again, there will be a proneness among investors to look for the holes, look for the cracks, look for any weakness, simply because the Magnificent Seven have been priced for perfection. I'm waiting to see the rest of the sectors start to participate in some way and reflect the overall resilience that is perhaps surprising across these other sectors.
Well, to that point, when you talk about that Magnificent Seven falling from their perch, where does that open up opportunities in the rest of the market?
Well, areas like infrastructure, utilities, healthcare, so-called value sectors, quite defensive, they have been essentially quite overlooked. And when their fundamentals are not changing, everything that was driving them around infrastructure and real assets being good inflation hedges. Remember, we're still dealing with inflation. It may still not be in headlines and it may have come down from its peak, but we are still dealing with it. The Fed is still mindful of it. And we need to have portfolios that are resilient and are participating in inflation. Equities do that to a degree, but infrastructure, real assets, real estate, they really participate in that. So I'd say that's been completely overlooked. Many babies have been thrown out with the bathwater in the last few weeks. We've seen that in some of the sustainable and renewable energy stocks, complete essentially washing out of those stocks simply because some of the expectations, the business models, the demand have not been up to scratch. That's probably a bit of an overreaction there. So I'd say there's lots of value in the so-called value sector and the defensive sectors that have not been participating in the Magnificent Seven.
Having said that, what are areas that you want to avoid completely?
I will say that I will say real estate right now, listed real estate, it is just too difficult to pick the sectors that are likely to prevail. I'll say that that's not one of our priorities at the moment. Other sectors, we're actually not that, we've always been avoiding areas like digital assets. There was a discussion earlier around some of the new financial mechanisms and exchanges. We've always been quite wary about those. We think they're unproven. And in a sense, we have not really got over the regional banking crisis within financials. So I'd say financials, whereas many of them are very strong. We've seen good earnings and good trading volume in financial stocks. I would say that most investors are just not interested right now in getting involved in financials with this uncertainty around the interest rate environment, as well as that overhang. The FTX trial is currently going on. We know about governance and about oversight and complexity that sank some of those stocks. I'd say that's an area I would want to avoid.
All right, Ethan, it's really great to catch up with you. Appreciate your time. Our thanks to Ethan DeWitt, Moneta Chief Investment Officer. And coming up, speaking of a second day on the stand for FTX founder Sam Bankman-Fried, we'll have the latest on his testimony.
And SoFi raises its revenue forecast after its deposits more than triple. You'll hear more from our interview with the CEO, Anthony Noto.
And we'll look at the growing demand from air travelers for so-called premium economy seats and also how the airlines are responding. All that and more coming up. This is The Close on Bloomberg.
Season is here.
Tons going on, lots of earnings.
Beat wherever you look.
Bloomberg breaks the numbers first.
It's a tale of two earnings. Results from Goldman Sachs, Bank of America, and Morgan Stanley.
Netflix is out, guys.
With exclusive expert analysis.
Recovery is underway.
They crushed it. It was one of their best quarters ever.
This is a story all about pricing power.
We're going to make more money. We're going to make more money. And we're going to make more money.
They're making bank, and I think that is what we could take away.
Bloomberg Television and Radio. Context changes everything.
All right, 45 minutes or so to go until the closing bell rings. You take a look at what's working in this market right now. Honestly, it's a lot of tech names after the hosing that they got last week. Now you have the likes of Microsoft, Amazon, Apple powering this market higher. Take a look at what's not having too good of a day, and it's the likes of some of these chip names behind me. Tesla, too, you can't even see it. It is down by about 4.8%. You think about the heft of Tesla, that is the biggest points contributor to the downsides. But with a lot of those other big tech peers rallying today, this market is managing to shake it off. And you can see that if you take a look at this dashboard here, the S&P 500 taking a look at its session highs right now, up about 1.3%. That's as the bond sell-off eases just a little bit, though. But you look at 10-year yields, still higher by about 3 basis points. But after the few months that we've had, maybe you can call that unchanged. The dollar not seeing much of a haven bid, down about 0.4%. And again, equities higher, and then the bond market also suffering a little bit, but just a little bit. But it's time now for Options Insight. We want to get you up to speed with the day's options trading. Abigail Doolittle standing by, taking a look at the relationship between the BOJ and volatility here in the U.S. Take it away, Abigail.
Absolutely, Katie. Well, it is a big week for central banks, and of course, the BOJ is Tuesday, or tonight for us here on the East Coast. And there was a story floated by the Nikkei earlier speculating that the BOJ may let the 10-year JGB go above 1%. Now, Samantha LeDuc, founder of LeDuc Trading, thanks so much for joining us. You've been all over this all year. I remember in late February, early March, the topic you wanted to talk about the next time we were talking was the BOJ, because you said you were watching the BOJ this year much more than the Fed. I think you're one of the few people doing that, but you're really out in front of the curve. What do you expect, and what would the influence on asset classes here in the U.S. be?
Well, the correlation between the dollar yen and the dollar yen, in other words, the U.S. 10-year with the dollar yen is just indisputable. So it's very, very strong correlation. And today with the Bank of Japan announcing that it may consider letting the 10-year exceed 1% is their effort towards a hawkish stance, which is normalization. And that's actually very different from the rest of global central banks, which are at the place of pause for the Fed, and in some cases, some regimes are kind of doing a pause and cut. So all eyes have already been on the Central Bank of Japan for a possibility of this yield curve control shift to normalization because of rising inflation. It's a really sticky point of contention, and obviously in the U.S. we've kind of done this dance where now it's perceived as very much entrenched, and the 10-year has been spiking higher after the last quarterly refinancing announcement from the Treasury back on July 31st. So, of course, all eyes are on the QRA this week. FOMC, there isn't much expected. In fact, the options market is pricing in very little move because very little is expected from that announcement. So all eyes are and should be on the Bank of Japan and what they do next.
So we were just taking a look at the VIX versus the yen, which I know that there's not much of a correlation there, but it does look like the VIX, at least over the last 2 years or so, and it depends on the time period, to be fair, that a rising dollar against the yen has suppressed volatility. So it'll be interesting to see, and I'm curious to know whether or not you think that could go higher if there's a technical case there for sure for the yen to strengthen, as in the dollar yen to go down. Maybe volatility spikes on that. What are your thoughts there, Samantha? And, earlier today, this had stocks off of the highs, and now we have this borrowing report from the Treasury. You're just talking about stocks back at the highs. What influence do you expect to be stronger on stocks?
Well, for me, the worry is, I should say the market worries that the Bank of Japan will reverse negative rates and pivots. So this could be an exit from the dollar safety and yield spread that they have been playing in this carry trade to the yen. So you could kind of see it last night into this morning. The Japanese yen, in fact, has gotten a bounce. It's been a nice chase trade. But the swing trade or even the trend is much more important, meaning the implication for U.S. Treasuries. It kind of bears reminding that the Bank of Japan has been the last bank to shift. This is a hawkish tone. Maybe, it creates this kind of price instability from a longer term standpoint. But in the short duration, what they typically do is we do some kind of dollar swap arrangement to kind of stem the volatility that the Bank of Japan moves can make. So this is very much the USD JPY 150, right? So this is like that point of intervention that they've promised to come in to keep the bond vigilantes at bay. Right. So if that is in fact the case, that we really could see the dollar, the U.S. dollar, fall at this kind of very key support of 105.77 Dixie. And if that's the case, it will give a little bit of relief to equities. Otherwise, it's very, very negative to equities and can trigger not only higher bond yields in the U.S., but also volatility.
Yeah, especially if that yen carry trade does to some degree unwind. But they're going to have to walk the talk that they're talking, because back in the summer they walked it back. But it sounds like you think they might be pretty strong. Samantha LeDuc, founder of LeDuc Trading, thanks so much for joining us for Options Insight today. And from New York, this is Bloomberg.
Well, first class, watch out, because U.S. flyers can't seem to get enough of premium economy. Now, according to the reporting from the Wall Street Journal, U.S. airlines are expanding offerings labeled Premium Plus, Premium Select, or Premium Economy, which typically come with roomier seats, early boarding, free alcohol, and nicer meals. And airlines say they appeal to travelers with more disposable income, especially on long-haul flights, where business class seats can run thousands of dollars more. Scarlett, I know you have a lot of feelings.
Yeah, well, if I can't afford business class when I'm flying, maybe I want to spring for things I used to be able to get for free 20 years ago, right? Like a pillow, food with real silverware, maybe not earplugs, headphones, a blanket, more seat room.
No.
But, since they've shrunk economy into just sitting there like a sardine, now they have premium economy where you can pay up for it.
Yeah, you still have to pay up. These are still expensive flights that we're talking about. Yep. I also think it's interesting reading the article, thinking that maybe this will appeal to corporate flyers from companies who maybe don't want to pay for business, because apparently that's also...
But we're not going to stick you in economy, so we'll pay up a little bit so you have premium economy. Yay!
You can extend your legs a little bit more. Interesting to watch.
Painful.
In any case, stocks up. We're going to get into it next. This is The Close on Bloomberg.
We've got about 30 minutes left to go in this trading day on this Monday. And Katie, we're continuing the streak of up Mondays for the S&P.
It seems like, I know you have some amazing size and scope. We're going to get to it. But you are looking at an S&P 500 that's looking at its session highs. You take a look at the circle behind me. It's all green, every single sector, all 11 in the green right now. You take a look at what is leading the rally. Communication services up top, 2.4% higher. Financials too having a great day, up about 1.9%. Consumer staples seeing some love. You go down the list to the relative underperformers. They're still green too. Energy up by about 0.2%. So too is real estate up by about 0.2%. Scarlett.
All right, let's take a look at some of the individual movers. And there's more green than red, clearly, given the overall broader market moves. Western Digital up by almost 8%. The storage maker will be splitting into two publicly traded separate companies after its talks to merge with the Japanese storage company collapsed. Western Digital will spin off its flash business, leaving it with just a hard disk drive business focused on selling memory to cloud data centers. SoFi Technologies had gained as much as 15%, but it's paired some of those advances, now up by only 1%. This is the financial services company that started its life as a student loan refinancing business. It had jumped after reporting its revenue forecast for this coming quarter will be better than what analysts had anticipated, thanks to a tripling in deposits. Now, the lone decliner here is on semiconductor, losing 20%, the worst performance in the S&P 500. The third quarter was fine, not a problem, but the fourth quarter revenue and profit outlook was weaker than expected, and that is dragging the semiconductor complex lower. At least it was when I checked earlier. And Krispy Kreme donut was off, was in the red earlier, but it's bounced back and is now up by 0.5%. Truist Securities downgrading to hold from buy, also reducing its price target to $13, saying that the uncertainty over Ozempic and those other weight loss drugs means we're not really clear on whether Ozempic will hurt demand for things like really yummy donuts. Katie?
Well, let's go from donuts to cryptocurrencies because FTX co-founder Sam Bankman-Fried, he's back on the stand at his fraud trial today where he faced cross-examination from prosecutors. Joining us now for the very latest is Bloomberg's Sonali Basak. And when you think about what we heard today, what was the tone? What was the line of questioning that we saw from the prosecution?
Well, there are a few things here. There's the prosecution, and also remember his own attorney had come up too in his defense. We know that the prosecution has really been line by line bringing up a lot of evidence, including what Sam Bankman-Fried himself has said to different news outlets, pre and post bankruptcy, online and in tweets. And there's so much ambiguity. It's actually very, very hard to follow this case because Sam himself will be disputing some of the things that were said in the press about him that he was even quoted on in relation to how he operated Alameda and FTX, or rather didn't operate Alameda anymore, but his relationship to Alameda.
He has said so many different things. You've got to pull it from the different times he's spoken. How did he explain his relationship to Carolyn Ellison and, of course, his former girlfriend, who is the CEO of Alameda, and how much did he refute her testimony in particular?
This is really important because she was such a big part of not only the prosecution's own case, but Sam Bankman-Fried's own defense. And importantly, in the defense's kind of pushback here to show that Sam Bankman-Fried didn't know everything that was going on, he spent a lot of time really disputing certain parts of her testimony as well as others. This idea that he was not a programmer and he didn't have a background in computer programming, so he wasn't reading or writing any of FTX's code, for example, or this idea that he didn't know exactly how much was owed between Alameda and FTX at the end of the day. And importantly, this was a big part of this idea that he asked them in the summer of 2022 and earlier to put on hedges, very particularly Caroline Ellison to put on hedges to hedge any crypto decline. And you even hear parts of Caroline Ellison's own testimony there, that there are moments of pushback. But the reason this is so critical is at the end of the day, we're seeing something we haven't seen to this scale in history before, which is him trying to convince a jury that he didn't know certain things about how Alameda operated. Now, will this be convincing enough? Certainly, if you weren't following for the last couple of years, it is hard to follow.
Yeah, the defense's incompetence?
Yeah.
You know, I'm not really good at this.
That it wasn't fraud. I just made a lot of mistakes. We'll see if that resonates, of course, with the jury, to your point. What do we have to look forward to through the rest of the week and through the rest of the trial, really?
So the prosecution has said that this would take a while. So into tomorrow, we expect the testimony to continue here of Sam Bankman-Fried, the prosecution really drilling into him. But then the prosecution also has a minute to rebut. They have a rebuttal case that they could put forward as well. By Thursday, maybe Friday, the Judge Kaplan had said that they may not finish by Thursday, could go into Friday, and then potentially a verdict by next week. So that's kind of the timeline we're looking forward to for the rest of the week.
Potentially a verdict by next week. Okay, what has surprised you the most? Because you've been following this closely. You've been talking to the different players from the very beginning. What kind of caught you by surprise?
Is it weird to say none of it? I mean, the reason it's not surprising to hear him be so ambiguous is this is what he has always done, isn't it? I did know this, I didn't know that. And so even right now, as we speak, very recently, he's very physically being presented quotes in CNBC and in Bloomberg. Did you say this? Did you spend 11 hours with Zeke Fox? And he says things like, oh, I'm not sure if I did this, or I'm not sure if that happened. And so it's very hard to hinge on him not knowing whether he said or did certain things. But, you know, frankly, a lot of the testimony, if I had to describe the tone, it was a pretty frenetic time for all of them. Now, again, the prosecution had put forward their own witnesses, and I think at the end of the day, it's one man versus the other.
The others,
exactly, which is the weirdness of this entire case.
A frenetic time with some pretty shoddy record keeping, as I understand it, of course, just complicating this case even more. Shonali Basak, thank you so much for that breakdown. Now, coming up on the close, shares of SoFi on the move after seeing deposits triple from a year earlier. It's our Stack of the Hour coming up next. This is The Close on Bloomberg.
We're really excited about the results that we delivered today. I think they're extraordinary in a number of different ways and equally as positive on the outlook. There's very few companies that are driving durable growth the way we are, plus 25% revenue growth, really strong member growth at 47% accelerated. We had a record number of new members added, as well as products, which is a testament to the value proposition that we're delivering. Our profitability continues to improve. We now have all three of our business segments that are profitable, that being the lending products, as well as tech platform, and now financial services. 67% growth in our absolute dollars on a year-over-year basis from non-lending, and that will continue to be the driver of the growth of the company. And we meaningfully grew tangible book value over the trailing 12 months of about $170 million. So I feel like we're executing across the board on both growth and profitability and shareholder value, and it's just a matter of time before that's reflected in the stock. We just have to keep delivering the way we have been.
That was SoFi CEO Anthony Noto, a bit in autopilot mode as he broke down the company's latest results. And we saw SoFi shares rally as much as 15%, but they have since pared their gains on the back of that positive earnings release. So let's bring in Sally Bakewell, who leads Bloomberg Finance coverage for the Americas. Exactly how does SoFi come off this quarter doing so well? It was a student loan refinancing company originally that then became a bank, but do its results match up with what we've seen from other banks?
That's right. It's been on a pretty impressive trajectory. So it started up as this kind of fintech upstart, and then in mid-2021, it merged with a SPAC and went public. And then about 8 months later, it actually bought a very tiny California bank called Golden Pacific Corp, which only had about 3 branches. But that enabled it to go from sort of fintech maverick to fully fledged bank that could take in deposits and issue loans. So now it's sort of diversified away from just being a student loan business and a personal loan business into a lot of other areas, including IPOs and SPACs. In fact, in the past quarter, it helped underwrite a number of IPOs, including the Instacart one, and that has enabled it to sort of expand its revenue sources so that it actually got 67% of its adjusted net revenue from non-lending businesses. And I think this is why it was able to have more positive earnings than perhaps some of its fintech peers.
Yeah, definitely a wide umbrella that SoFi has cast. But talk to us a little bit more about the deposit growth, because that definitely caught my attention. The fact that deposits tripled in the third quarter. Where are those new deposits coming from?
So Anthony Noto, the CEO, he said that they're very high quality direct deposits. Now, if you look at what SoFi is offering, it is offering 4.6% APY on one of its accounts with no fees. And when you compare that to what's available elsewhere, it's pretty compelling. You can understand why it has this lure. And also, if it pulls in more deposits, well, that deposits are the lowest form of funding for banks. And so that helps it expand who it lends to. And ultimately, therefore, that is a source of growth. And the company was able to raise its revenue guidance for 2023 as a result. And we also heard about this potential deal that it's working on with BlackRock, which is a personal loan securitization of about $375 million that would be placed exclusively with BlackRock funds. Now, that, again, is another kind of sign of confidence. If it's able to work in the sort of in that tier with that kind of firm, that this is on a solid footing.
It's great that you can give us the full picture of what SoFi does, all the different fingers, all the different pies it has its fingers in, because typically when there's some news, some headline on student loans, SoFi stock moves in reaction, even though that's just a part of its business now. How sensitive is it still to all those student loan headlines?
So Noto, again, he today said it was less of a sort of consequential part of its business. And, you know, the company has been very sort of active and vocal in the student loan space.
Yeah.
It actually sued the US government earlier this year over the moratorium, which was eventually dropped as part of the debt ceiling talks. So it dropped its complaint. And I think as part of this big diversification, it has been sort of expanding beyond that business in order not to rely on a business that is so subject to political whims.
All right, Sally, great breakdown. Really appreciate your time breaking down SoFi's earnings. Our thanks to Sally Bakewell. She is the head of Bloomberg's America's finance team. You take a look at markets right now as we head towards the closing bell. About 15 minutes to go. The S&P 500 up by about 1.3%. Big tech too as well. Even as we start to see, of course, that bond sell-off resume. We got a little bit of a wobble, a little bit of a bid come back into the market after we got an update on Treasury's borrowing needs, but you can still see 10-year yields higher by about 5 basis points at this time.
You know, I look at the industry groups for the S&P 500 just to get a sense of what's up, what's down. 23 out of 24 groups are in the green. The only group that's down, do you know which one?
Tell me.
It's autos because of Tesla.
Because of Tesla. Yeah, that would do it. Interesting to see Tesla down pretty mightily on a day where the overall index is up. It's not too often that you see that. Still ahead, of course, as we go down to those closing bells. We're counting you down to the close with Amanda Agati. She is Chief Investment Officer at PNC Asset Management. That conversation coming up next. This is Bloomberg.
This is the countdown to the close. I'm Scarlett Fu.
And I'm Katie Greifeld.
And we're at the start of a pretty momentous week when it comes to news events that'll trigger moves in the market, right? You've got earnings from Apple. You've got the FOMC decision on Wednesday. You've got the jobs report on Friday. No shortage of catalysts here.
No shortage of catalysts. It's going to be a lot of fun. And honestly, in terms of what is the biggest market moving event, I don't know, and I'm sure there's a few surprises out there that we aren't even thinking about.
Yeah, notably, the Treasury refunding announcement that did come in at 3 p.m. that indicated the U.S. won't have to borrow as much as perhaps it thought it did, providing a little bit of relief, although you still see yields moving higher.
Yeah, and you can see that the S&P 500 it's floating near its session highs of the day. Again, as we count down to a big, big week. And to help us do that, let's welcome in Amanda Agati. She is Chief Investment Officer at PNC Asset Management. And Amanda, I'll bring you the question that we've been trying to answer all day. When you look at the full spectrum of this week, you have central banks, you have earnings, you have economic data, the list goes on. What are you most focused on?
Well, thank you so much for having me. It's always nice to be with you. I feel like a broken record because the thing that we've been focused on all year and will continue to be focused on for this week is what is the Fed going to do or perhaps not do is more what I should be saying for this week. That matters most in terms of the path forward. Try as we might to get the Fed out of the driver's seat all year, the Fed is still very much in the driver's seat. And so we think that is the single most critical catalyst for the market's path forward.
And so with that in mind, what would be the surprise that we could get on Wednesday that would drive the market?
Well, we're not expecting a surprise. So our view on what happens this week is that we get a very hawkish tone, but a pause in terms of any kind of policy action. And so to the extent that it's anything other than that, I think it will certainly rattle markets and perhaps catalyze a little bit more of a downdraft than what we've already experienced here. I think the markets and the Fed are just still very much not on the same page. Market is so quick to expect a policy pivot here to rate cuts. And just given how the data is coming in, how strong the consumer, how resilient they continue to be, there's plenty of ammo for the Fed to take another step if they feel like it's warranted. And so that's the thing that's perhaps keeping me up at night the most, that the Fed may still need to take some policy action, even if they don't ultimately do it this week.
Yeah, a hawkish pause is basically what you're describing, and maybe to some extent what markets don't want to hear, but are also reluctantly pricing in as well. When you look at the yield curve, and of course we've seen the longer end of the yield curve move more quickly than the shorter end. We've had this flattening yield curve this inverted yield curve for so long. Now that it's moving the other direction, that's raising a lot of eyebrows and causing some concern that that's an indication that things are going to get really tough here.
It usually tends to be a pretty strong signal of, oh boy, look out below. Something major is about to change in terms of the backdrop, but it really depends on what is driving the yield curve kind of normalization or steepening. And so when we're looking at long-term rates rising here, there's a whole series of potential reasons for it. It could certainly be a reflection of how strong economic growth has been coming in. It could certainly be a reflection of the consumer, but I think it could also be this recognition that the Fed's going to have to do more. And so it's not a perfect predictor for what comes next in terms of the economic cycle, but it's something that we certainly have taken note of, and it's certainly going to continue to put a lot of pressure on high valuation stocks here.
And of course, over the last couple of days, we haven't had much Fed talk to dissect because they've been in their quiet period, and that'll be the case until Wednesday. So we're really sifting through all the corporate earnings. What have you observed when it comes to margins for companies? Because for so long, they were able to pass on higher costs to their customer, to the end consumer, but it looks like perhaps they've hit a wall with that.
That's absolutely what we're starting to see. Outside of the Magnificent Seven, who continue to kind of lead the charge here from a results perspective, starting to see quite a bit of pressure in terms of the ability to price through cost increases. But of course, the inflationary backdrop is still pretty elevated. It's moderating a bit, but we're not moving in the opposite direction. We're not seeing deceleration materially here in terms of inflation. And so the ability to pass through those price increases just gets harder and harder. And I think that's really why you're starting to see the Magnificent Seven, a lot of pressure in terms of earnings growth rates, both in results for Q3, but also expectations for Q4. A lot of negative revisions starting to come into the equation here. That's starting to accelerate. And so as that continues to weigh on the backdrop, we think that's going to continue to put pressure on the market, even at these valuation levels.
And is that a market-wide sentiment? If you take a look, for example, at the different sectors, are there any sectors or industries that are bucking that trend and actually benefiting from this environment?
It doesn't really seem like it. When you look under the hood, the Magnificent Seven, it's really sort of exactly what we would expect to see in the later innings of the cycle, sort of muddling along. I can't point to one particular industry or sector as a standout, and so I think that speaks volumes about where we are. If you look under the hood, market performance and even the underlying fundamental results are suggesting that we are in the late innings of the cycle. And so I've said all year, this market continues to be pretty delusional. We finally started to see a bit of a reality check here with the 10% drawdown or correction that we've had. But I think the bias is still down a bit further from here, if not choppy and range bound, just because I don't think there's a lot of room for companies to materially move the needle in this environment, and certainly at these valuation levels, and certainly where margins are sitting today. There's just not a lot of upside from here right now.
And Amanda, we only have about less than a minute left with you, but what is the late cycle playbook? What should your portfolio look like?
Well, we're still very much running a defensive playbook. We've kind of been in this mode all year, but defense to us is not running to the sidelines and raising a ton of cash. It's trying to de-risk, trying to be very thoughtful around strategic positioning, long-term targets, staying very well diversified, and leaning very much into quality exposures, both on the equity side and fixed income side. So in fixed income in particular, with rates where they're moving, very, very attractive opportunities in high grade, investment grade fixed income. Investors aren't getting paid at these spread levels to take on the risk in below investment grade credit. So we'd be leaning quality on both sides of the equation.
All right, good stuff. Amanda, thank you so much for joining us. Amanda Gotti is with PNC Asset Management, and we are looking at a stock market that is in rally mode here with the S&P down, NASDAQ, each up by more than 1%. In fact, 10 out of the 11 industry groups are higher right now, the exception being the group that includes Tesla, which, you know, odd to see Tesla continue to struggle here.
Yeah, Tesla having a tough day. Market overall doing well, of course, as we've been saying all afternoon. This is a busy week. There's a lot of fundamental catalysts here, so it's going to be really interesting to see how we trade.
All right, we're moving closer to the closing bell. We've got full market coverage right here on Bloomberg. As we take you to the bell and beyond, this is the close on Bloomberg.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
We're about 2 minutes away from the end of the trading day on this Monday. Scarlett Fu and Katie Greifeld here, counting you down to the closing bell, and here to help us take you beyond the bell with a global simulcast, Carol Massar and Tim Stenovic. Welcome to all of our Bloomberg audiences across television, radio, and YouTube. Carol, there have been 17 weeks in which the S&P 500 has, or I should say in the past 17 weeks, there are 16 weeks in which the S&P 500 has closed higher on a Monday, and today's looking like it's going to be one of those.
Interesting, right?
Yeah, what does it mean?
Wait,
I don't know what
can
to
we
do
do
with
this
that
on a
stat.
Monday? Can we do this on a Monday?
Wasn't last week the first one in 16, Scarlett?
Last week was the 1 week in which it didn't close up. I'm not sure what to make of this either, except that lately, since the Israel-Hamas war began, there was definitely reluctance to be long on a Friday. So maybe there's a little bit of a make back on a Monday, but that doesn't account for 17 weeks.
There's
right?
a lot of stuff. Fed meeting, Apple earnings, jobs report, right?
That's true.
It's a
big
lot of
week.
stuff.
Treasury refunding, that's happening too.
Nice job sliding that in.
Katie, we just spoke to Max Wasserman over at Miramar Capital, who talked today about this being a relief rally. He said, you know, people were concerned going into the week, and as you mentioned, Scarlett, that things could escalate even more than they did between Israel and Hamas. But I question why we're seeing the bond market moves that we're seeing today, and we're also seeing the equity market moves.
Yeah, of course, you see that sell-off continuing in the bond market, even as we get the Treasury's borrowing estimates, less than expected. Still, you know, amazing amounts of money, but still, that wasn't worth too much when you look at what happened in yields afterwards.
Yeah, just a bit of a leg lower in both the 2-year and the 10-year, but not enough to change the overall direction. There's the closing balance, and it does look like we're going to finish higher on the day. It doesn't look that way for the month, but that's a separate story. We have the S&P 500 up by 1.6%, or I should say 1.2%. I'm looking at the Dow Jones up by 1.6%, and the NASDAQ gaining 1.2% as well. And the laggard here is the Russell 2000 up by 2/3%, but notably higher as well.
All right, we're going to get a breakdown into the groups in just a moment. Some individual movers. We're watching some earnings. But if I look at the S&P 500, guys, 399 names, Scarlett, to the upside, 102 to the downside, 2 unchanged. So investors willing to do some buying today.
Willing to do some buying. That shows up in the industry groups as well. 24 industry groups. The only sector in the red right now is the autos and components one. That includes Tesla, off by 4.1%. See that red bar at the very bottom? That's the autos group. Everything else in the green, including, let's see, 4 groups that have gained at least 2%. Retail, telecoms, and transportation leading the way here.
All right, guys, let's get to some of the individual gainers in today's session. And McDonald's is definitely on that list, up 2.5% at its highs, finishing the day with about a 1.7% gain. Has to do after it came out with its quarterly update. Third quarter sales and profits, it was a beat thanks to higher prices and movie-inspired ads. U.S. customer traffic, though, it did dip for the first time this year. So just something to keep in mind that not every report. What?
Okay, I'm sorry to cut you off. Romaine's not here, so I'm going to interrupt you
no.
instead.
What? No way.
Why are people freaking out about Ozempic and stuff when it comes to the donut places, but not McDonald's? Like
Good
crisp,
question.
I don't know. I'm just asking a question. I don't know.
That's a fair
Because
question.
we still eat burgers. Burgers are protein.
They have salads,
Donuts are
they
not
have
protein.
water, like they
have some good
have
pricing
water.
power, which is also
They have water.
important.
They also have shakes. They're delicious.
and French fries.
And French fries are vegetables.
All right, comp sales also a beat. I'm
Sorry.
moving on. I'm ignoring the substitute romaine today. Comp sales a beat, up 8.8% in the period versus 7.8% average of the estimate we polled here at Bloomberg. Delivery digital channels also contributed to sales growth. It was its slowest sales growth, though, of the year. So just a little bit of a caveat. Western Digital, number one gainer in the S&P 500, up 7.2%. It was up more than 13% at its highs today. The company said it would separate its HDD and flash businesses into two public companies. It also reported its first quarter results and gave a forecast. So investors liking some of that news, although not as enthusiastic as it was earlier in the session, as we said, up more than 13% at its highs. And then Amazon, this was an outperformer in today's session as well. We'll bring up the numbers for you. It was up about 3.9% in today's trade. Top of the NASDAQ 100, Fidelity Magellan adding Amazon to its investments, a new buy. They added about 9.14 million shares valued at $1.16 billion. So that was definitely a standout. Also, the analysts have been raising their price targets on the company since it reported. So there's some momentum in that one, you guys.
All right. Well, I was actually, even though we were up on the day, had a pretty easy time finding in the S&P 500 stocks that did move lower. Scarlett, you talked about Tesla a little earlier. The worst performer on a points basis in the S&P 500, down 4.81% today. It closed at its lowest level since May, we should note. Panasonic Holdings earlier in the day reported that its automotive batteries operations fell to their first loss in the quarter in 3 quarters on lackluster demand for Tesla Model S and Model X. So that could have been one of the reasons it moved lower. We also saw BYD, it's China's top-selling car brand, did report record quarterly profits. So perhaps because a competitor did report some good numbers, especially in the wake of that recent earnings call where we heard a dour Elon Musk on the call. On semiconductor, the worst performer on a percentage basis in the S&P 500, closing down more than 20%, 21.77%. Biggest intraday drop going all the way back to March of 2020. The company gave fourth quarter forecast that was weaker than expected in terms of adjusted earnings and in terms of revenue. Similar reason we saw move lower for Revity, closing down today, more than, 16%? Wow. The deepest intraday plunge since December of 2008 at its lowest down to 2002 levels at one point in the day. This after the company cut its revenue forecast for the full year, Scarlett.
Actually, it's
Oh,
my
Katie.
turn, Tim.
Excuse
Let's get
me.
to the bond market because this is really interesting here. We did get the Treasury come out with its net borrowing estimates. Net borrowing estimates for October through December for that quarter came in at $776 billion. That had been predicted at $852 billion. Even still, even with a little bit of relief there, maybe the Treasury is going to announce that they're going to have to sell less debt on Wednesday. You didn't see too much of a reaction in the bond market. That sell-off continuing. You can see 2-year yields up 3 to 4 basis points. 10-year yields, similar story, less so across the curve, but all told, pretty small moves, but just continuing that trend, Scarlett, of this sell-off, those marches towards higher yields.
Yeah, today it's the stealth sell-off, but it's still happening, right?
Exactly.
As long as you see those yields moving up. You know, when it comes to U.S. earnings, we've seen the bulk of the numbers. I'm really excited about Apple because I can't wait to hear what the company has to say about China in particular with Chinese consumers. I wouldn't say souring on Apple devices, but the government certainly is souring on Apple devices. And
we are getting some
like
evidence,
Huawei now.
Scarlett, that the Chinese consumers are souring on at least the latest high-end version of its iPhone. We're going to be talking about that with Mark Gurman a little bit later because it sounds like there's some real competition from Huawei. Yeah.
Right. No, it's interesting, right? Yeah, the increased competition in the domestic market. It's one of those markets that Apple has certainly, identified, like so many other companies, as a tremendous growth opportunity. So you do wonder if you have individuals there saying, nope, they're going to be buying. Although Mark has said to us that it's still considered kind of a coveted device, right? Apple device in China.
Super high end, but it's also not as sticky in China because a lot of the apps that they use there are over the top apps, right? These super apps that you can use equally well on an Android or an Apple.
Well, before we get to Apple, we do have some results from Pinterest coming out with their third quarter numbers. Third quarter revenue came in at $763 million. The estimate had been for $744 million. Third quarter EPS, though, 1 cent. Had been expecting a loss per share of about 10 cents over a year. You take a look at the third quarter adjusted EPS, that was 28 cents. The estimate had been for 20 cents. So a beat there, and you can see that reflected in the shares, toggling around a bit, but clearly higher, up by more than about 5%. And this was a company that needed it because coming into today's close, this company only up about 3% year to date, but clearly some good news here, at least in after hours initial trading.
You wonder if some of this, the big bounce in the aftermarket up 5.5% is because about 5% of the float was shorted. So maybe a little bit of short covering potentially. Keep in mind that this is a stock, 25 and change that it closed at in today's session, but it is down more than 70% from its February 2021 high. So a lot of ground to make up if that was the more accurate valuation, if you will, or metric.
Yeah, I'm going through the press release here, and the company's CEO, Scarlett, Bill Reddy, saying that the company's seeing its best market fit at this point in years for Pinterest.
I still don't get this company and what it does and why people go to it.
I'm glad you said it and not me.
I
Weddings
will say,
and renovations.
I'm with you too.
The amount of time that I spend thinking about Pinterest relative to the amount that I hear about Pinterest is pretty skewed. But apparently, if you look at their monthly active users, 482 million. That is an 8.3% increase year over year, and it beats estimates. So people are clearly using it.
We gotta work on our vision boards.
Apparently,
I think.
Yeah. Who would have thought the business model would be, I'm going to monetize mood boards?
Oh, did I say it wrong? Mood board.
No, mood boards, vision
boards.
Same thing.
It's whatever you want it to be.
I'm just going to mention real quickly, Tenet Healthcare also out, and that stock's up about 3% in the aftermarket following its quarterly update. So for more information, head to Bloomberg.com. And Pinterest, yeah, still up 6%. Scarlett, I'm with you. We'll try and figure out.
Yeah.
What we're supposed to do
in
with
fact,
this.
we'll get into it with Mandeep Singh next, right after the closing bell. That does it, right, for cross-platform coverage?
Yeah, that's a wrap. We'll see you guys again tomorrow beyond the bell. Join us at 4 p.m. Wall Street time.
All right, and coming up, we've got more on Pinterest results, those 482 million monthly active users for this vision board, this mood board. I want to understand, what do they get out of it? This is The Close on Bloomberg.
All right, trading is finished on this Monday, and it was a good Monday for the U.S. stock market. Once again, you had the S&P 500 finish 1.2% higher. Same thing if you take a look at big tech, up 1.1%, just slightly less good for big tech. All while that bond sell-off continued to build. You had the 10-year yield rise by about 5 basis points. Currently, the 10-year yield stacking in at 4.88. Of course, we got to 5% last week. We're a little bit below that now. We'll see how this week's goes. And of course, I wanted to talk about crude a little bit because crude continuing to fall. Its quiet slide down 3.6% today, below $83 a barrel. But we go from the big indexes to some of these individual names. I wanted to highlight Western Digital rising after announcing plans to split into 2 companies. That was after talks to potentially merge with the Japanese storage company fell through. Shares up 7.3%. SoFi coming out reporting earnings, actually having a great quarter. Deposits tripled. They raised their outlook as well. Shares opened much higher. They're going to finish about 1% higher, but of course that rally has come in quite a bit. And I also wanted to highlight Ford. Of course, the news is that those 3 automakers have reached deals with the UAW. You take a look at Ford, though, shares finishing almost 2% lower on the day. And we go from the micro back to some of the big picture here because, of course, with this big drawdown that we've seen in the NASDAQ 100, you take a look at valuations, this index is still overvalued. You're looking at the PE ratio, and on a 12-month forward basis, it's come down quite a bit, as you can see, of course, as big tech has fallen from its highs, but still it's above its 10-year average, as you can see in yellow. Getting closer, Scarlett, but still overvalued if you look over the past decade.
Yeah, and that is why we continue to see declines in the NASDAQ for the month of October, although today did buck that trend. We're taking a look, of course, at Pinterest right now. It is higher in after-hours trading after reporting a profit for the third quarter, EPS of 1 cent versus a loss the previous year of 10 cents per share. In terms of monthly active users, 482 million monthly active users, beating the analyst estimate of 473, and adjusted EPS also coming in higher. The average revenue per user was $1.61, matching the average analyst estimate. Mandeep Singh, Bloomberg Intelligence senior technology analyst, joins us here. And I joke about this a lot, about how I don't quite understand Pinterest and what the purpose of it is, but you made the point to me that it's a well-trafficked website and therefore it can monetize those visits.
Yeah, and look, I think they laid out a 3 to 5 year plan at their investor day last month. So where they said we can accelerate the growth to mid to high teens. So they clearly seem to be on the path to that. And look, they have increased the ad loads. Basically, the user growth in the US seems to be flat. Even though top line MAU number is 8%, in the US it's flat. So for this company to grow revenue, it's all about ARPU growth. And the way they're going to generate ARPU growth is by increasing ad loads, as well as partnerships like the one they have with Amazon, where they direct the traffic to Amazon. It makes for a good experience because then you can shop at Amazon and complete the purchase. And I think that makes sense.
So it's a very efficient business model, even if it's not scaled up. Is it okay for this company not to be scaled up, to only have less than 500 million users?
I mean, you see that in their numbers. So the DAU to MAU metric, out of all the social media platforms, they're around 20 to 25%. Everybody else is over 50%. So that tells you daily active users don't come. It's even though monthly active users are there, daily active users are much lower. So clearly, it's a niche platform, but they have found a way to monetize it.
And what does growth look like from Pinterest? Is that taking share, taking eyeballs away from other social media platforms, or is this additive?
I mean, this is a very competitive space. Pinterest is competing with the likes of Instagram. Everyone who's looking for idea generation is going to all these platforms. And that's where I feel they just have to have a unique differentiation. So content matters. Having those creators on the platform matters. But look, the generative AI aspect is also huge because we know Gen AI will impact how creators create content. And at the end of the day, they have to keep innovating to keep the creators on the platform because they're not at the same scale as a Meta is with Instagram.
And I got to say, just quickly on Pinterest, I know we want to get to Meta, but we've been joking about it. Who is their user? Is it millennials? Is it Gen Z? Who is the average Pinterest user that they're trying to target?
I mean, look, the daily active user number tells you the 20 to 25 million. It is a lot more niche-y. It's women and, people who are looking for specific occasions and looking for recipes, that kind of stuff. And that's where it's not unique, but they have found a way to kind of craft a narrative around that. And they've been able to sustain that user base. It's not growing in the US, but they've been able to sustain that user base. And look, that's where it comes down to content. If you lose your creators, you're going to lose the engagement. But so far, they've done that well.
Jack up the ARPU. That's the way to go here for Pinterest. You mentioned Meta through Instagram. Of course, Meta is going to offer an ad-free version of Facebook and Instagram in Europe because that region is cracking down on the way the social media companies treat data. I got to ask, is this something that's going to eventually spread to the US, you think?
I mean, look, the problem for Meta is hard to pivot to subscriptions because their average revenue per user in the US is north of $200. Even if you launch a $20 subscription, you don't get to that ARPU. So for them to really pivot to subscriptions, it's hard. But look, every streaming company is launching an ad-based tier. So it's not surprising that social media ad-based companies are launching subscription tiers. And it may work in Europe because they are cracking down on privacy and ad targeting. So it makes sense, for them to retain their users. I can't imagine social media users paying for using the platform.
Would you pay for it?
No, absolutely not. I mean, for Twitter, maybe. But for Facebook, I don't think so. We've had a nice 15-year run, but that's maybe when I would say goodbye. But in the case of Meta, could this be a case of they'll see how it goes in Europe, and if it takes off, maybe they'll bring it to the US?
It's still hard. The math doesn't work. So are you going to launch a $20 subscription? Because that's how you get to over $200 in ARPU annually. And that's where I think Pinterest has a chance. Because its ad targeting is focused on what you are doing on the app or the website. Whereas in the case of Meta, they have a family of apps. They are targeting it based on the usage across the family of apps. So anything that's going on in Europe that's privacy focused, I think helps Pinterest. And you see it in their numbers. The ARPU number accelerated for Pinterest in Europe. So maybe there is a sign there.
All right, it's going to be fun to see how that plays out. Mandeep Singh of Bloomberg Intelligence, great to catch up with you. Thank you so much. Now, coming up on the close, we'll speak with Seth Harris. He is former U.S. Labor Secretary. We're going to get his insight on the UAW's tentative agreements with the big three automakers. That conversation coming up next. This is Bloomberg. Now, with today's GM announcement, the United Auto Workers has now reached tentative deals with all three of Detroit's biggest automakers. But the UAW already urging unions in the U.S. to prepare for May Day strikes in 2028 when these tentative deals would expire. Joining us now for more perspective is Seth Harris. I'm pleased to say he is former U.S. Labor Secretary and currently a distinguished professor of practice at Northeastern University. It's great to have you with us. And before we get to 2028, let's just reflect on what we've seen over the past week, because you put in your notes, the UAW has tried to organize with these plants in the past, obviously finally successfully here. What changed that they were able to score this win?
Well, a lot of things changed. The leadership changed, and they were much, much more militant. The members are much more activist. But we have very, very tight labor markets. We have a culture that's very supportive of unions, and in particular was supportive of the UAW. And we have a president and a political system that was very supportive of the UAW. So it was a very good time to strike because the iron was hot. And the UAW won another big success for the labor movement. There have been a number of them this year, but also in the last couple of years.
And talk to us a little bit about what this means for both the Biden administration, but also Biden, the candidate, as well, because like you said, he's really positioned himself as pro-union here.
He's said that he's the most pro-union president in history, and he proved it in this context of this strike by going to the picket line and putting his arm around a striker and saying, you should demand more. And they did. Now, he's not the reason that they won this strike. That was the members who won this strike, showing a lot of courage and going along with a leadership strategy that was a little bit risky. This stand-up strike strategy hadn't been tried in the auto industry before or in manufacturing. It had been tried in the airline industry. It was immensely successful here. It means a lot for the president because what the workers won in this strike was right at the core of his economic agenda, which is a bottom-up, middle-out strategy, put money in the pockets of working people, mostly by giving them power to demand that money, and then they will turn around and they will spend it, and it will strengthen our economy. Remember, consumption is 2/3 of the American economy, and these are the people who are buying goods and services. With the lavish wage increases that these folks have gotten from this contract, with cost of living adjustments, with the big raises that temporary workers and newly hired workers get, they're going to have plenty more to spend. They might even be able to afford the cars that they're making.
Yeah, that was a big talking point they often came back to, was the idea that with the wages they were getting paid, they couldn't afford to buy the vehicles that they were making. What is it about Sean Fain's strategy that worked so well this time around compared to previous efforts to strike against the automakers?
The past strategy the UAW employed was to negotiate with one company and get a deal with that company, and then that would set the pattern for the other two. So it was pattern bargaining by contract. This time what the UAW did by negotiating with all three at the same time was pattern bargaining by issue. So they would whipsaw the companies back and forth against each other to push them up one issue at a time. And then the highest any one company reached became the standard for all three of the companies. And they got a really outstanding contract as a result. It's one of the best contracts that we've seen since the beginning of this century, certainly in the auto industry, and it's right up there with the Teamsters deal with UPS as a great contract for the labor movement.
Yeah, the union didn't get exactly what it wanted, but it got more certainly than a lot of people had anticipated, and it clawed back a lot of the losses from that they had given up since the 2008 financial crisis when the automakers, save Ford, went into bankruptcy. Is this a template, Seth, do you think, for other industries where they face organized workers?
Well, it's hard to say. I think for workers like auto workers and writers in Hollywood and healthcare workers and to like Teamsters at UPS, if it is very, very hard for an employer to replace you, then I think you can make significant demands and get a much, much, much better contract. And all of those groups of workers were immensely successful, even dating back to the John Deere negotiations in 2021. But for workers, unfortunately, like the baristas at Starbucks or the warehouse workers at Amazon, it's much, much more difficult to get a contract because employers still have a tremendous amount of power and they have the ability to replace workers if they go out on strike, because there aren't really barriers to entry. There's not skills or licensures or credentials or just a mass union density for the employer. There's no way that UPS could have replaced 330,000 truck drivers. There's no way the UAW could have replaced 150,000. I'm sorry, that the big three automakers could have replaced 150,000 auto workers. But for others, it's much, much more difficult.
And we only have less than a minute left with you, I'm sad to say. But take us forward to 2028 when these contracts expire. Are we going to end up in this situation again?
I don't think so, because I think both sides have learned a lesson. The UAW has a new template for how it's going to fight. The auto companies now understand how they're going to have to deal with the UAW going forward. But also, I think they've undone a lot of the concessions that were done before. Yeah. Negotiating going forward should be a lot easier.
Yeah, I don't think they want to deal with Sean Fain again.
No.
That's my guess. Seth, thank you so much. Seth Harris is the former U.S. Labor Secretary, and he is currently a distinguished professor of practice at Northeastern University in Boston. Now, coming up on The Close, China hosting its twice-a-decade financial work conference. We're going to discuss what that means for investors in China with Michael Herson, head of China research at 22V Research. You can bet on a lot of focus on the ailing property market. This is Bloomberg. I'm Scarlett Fu. Let's take a look at how markets performed on this Monday. As has been the case for the past 16 out of 17 Mondays, the S&P 500 finished today with a gain, closing up 1.2%. You had 23 out of 24 industry groups climbing higher. It's going to be a big, big week for earnings. You've got Apple reporting its results. You've also got the Federal Reserve, along with two other central banks, coming out with their decisions, along with the jobs report on Friday. So a lot for investors to get their head around. The BOJ will, of course, be giving its policy decision later on tonight, and we saw the yen surge. You can see dollar-yen down by 0.4%. As the Nikkei reported, the BOJ will likely tweak its yield curve control policy at the meeting decision today. And as we saw gains in equities, we see the VIX come down slightly. It's below 20, so some complacency in the market there. But again, all eyes pointing towards Wednesday when Jerome Powell makes the decision with his colleagues on interest rates and gives clues on what's next for the Fed policy. Katie?
So a lot to look forward to. But before we get there, Apple, it's holding their final event of the year tonight, where the company is expected to unveil two new Macs and processors. And of course, this is as data shows that the iPhone is losing ground to competitors in China. Let's break it all down now with Bloomberg's Mark Gurman. And Mark, I want to start with the Scary Fast event. That's what it's called, what they're holding tonight. What exactly are we expecting out of some of those products?
Yeah, so today is all about the Mac, and it's all about processors. So at its core, Apple's announcing three new chips tonight: the M3, the M3 Pro, and the M3 Max. These are their first 3-nanometer chips. What that means is they're using a new production technology developed by TSMC and produced by TSMC that makes the chips much more efficient, faster, better on battery life, and Apple's designs for these new chips are going to incorporate about 15 to 20% faster CPU speeds, so the overall speed of the computer. But the graphics side is where things get really, perhaps, scary for the competition, where Apple's really turning up the dial on graphics performance, particularly on those new high-end MacBook Pros, the biggest MacBook Pros with those M3 Max processors. So certainly tonight is going to be all about speeds and feeds and core underlying technologies, not the more exciting stuff for most consumers like iPhones and AirPods.
When was the last time Apple made such a transformative change to its lineup of PCs? I'm just curious what segment of the market is going to go out there and buy these new products right away.
Yeah, in terms of new chips, right, 2020, the end of 2020 is when they introduced the M1, which was the company's first in-house processor for its computers to replace Intel, right? So this is going to be the most significant change to their processor since then. The M2, you can say, was more of a stopgap chip. It didn't really bring major enhancements. It kept things moving along in the right direction. But this is the real new chip technology that everyone in the computer industry has been waiting for. And these are very hard to make, very slow to make, and there's a lot of challenges right now for the whole industry to make this new type of processor. So Apple's starting off with two of its lower volume machines to put them into. That's the iMac desktop and those MacBook Pros I mentioned. And so you'll see them first appear in those machines.
And Mark, just quickly before we let you go, talk to us a little bit about China, of course, because there was data suggesting that China's consumers are buying Huawei's made-in-China smartphone over Apple's latest offering. How worrisome is that for this company?
If that is true, it would be very worrisome. Obviously, Greater China represents about a fifth or 20% of Apple's overall sales, right? And so you don't want to see, if you're Apple, those sales, that mind share going to Huawei. Obviously, we've been expecting this since those reports from us and others about the government bans on some of the American design devices like the iPhone and the Apple Watch. Certainly, we'll probably get more color on that during Apple's earnings report for the fourth quarter on Thursday, but we'll really not know for sure until the end of January, early February, when they announce their Q1 results. That's when we'll get a full, complete picture of the first full quarter of iPhone 15 sales. So I would say we'll get a little bit of knowledge on what's really going on this week, and we'll know everything in the end of January, early February.
All right, Mark Gurman, our go-to man for all things Apple. Thank you so much, Mark Gurman, reporting for us from Los Angeles. And of course, we talked about China. We're going to stay with China because President Xi Jinping is hosting a financial work conference in Beijing. This is part of an attempt to tighten control of the country's $61 trillion financial industry. This closed-door, twice-a-decade event gathers state leaders and top bankers to really set the direction over the next 5 years. So for more, we're bringing in Michael Herson. He is a Senior Managing Director and Head of China Research at 22V Research. Michael, good to see you.
Good to be here.
So this financial work conference, does it actually lead to significant policy announcements, or is it more kind of a tweak of what's already in place?
Well, sometimes it leads to big reforms. We've seen that in the past. I think we're not going to see any big bang announcements this time. Xi Jinping has been here for 10 years. There was a major overhaul of the whole financial apparatus in March. So I think this is going to be more about implementation, and a lot of it is going to be political, as you said. It's really about tightening the party's control over the financial sector. But there still are going to be a lot of signals that are relevant for markets, even if those are couched in a very political language.
Tightening control over the financial industry. This is Xi Jinping we're talking about. He has pretty much iron control over the economy, over the financial industry. Which parts of it does he still need to tighten control over?
It's a great question. It's really about having financial policy making come from the party and not from the cabinet, which was more of a technocratic body before. And the reason for doing that is that means that when you send out regulatory directives, that's now a political directive to the whole system, which means if, for example, you flout regulatory guidance, now you're in trouble with the party's disciplinary mechanism. So it's not as though Xi Jinping didn't have any oversight of the financial sector, but it means that when it comes to ensuring compliance all the way down the line to the local level, and that's going to be very important as we talk about local government debt, it carries much more political weight than it used to.
Let's talk about topics here, because obviously one of the biggest issues facing China right now is its own property sector. What will the conversation, do you anticipate, sound like around that?
I think we're likely to see some signs of support for the property sector. For example, financing for areas of property that have a social function as well. There's this urban village renovation scheme that will likely see support to fund those kinds of projects. What I think would be the most interesting area, but one I'm still skeptical, is if we saw signs of coming to the aid of the private property developers. That is probably the single most important thing that Beijing could do to stabilize the property market. But Xi Jinping regards many of these private property developers as bad actors. We're now 3 years into this campaign to cut leverage to the property developers. So I don't think we're going to see that. But that language around support for developers is going to be very important.
So that's a potential wild card, of course, what might happen with the private property developers. But talk to us a little bit about what's needed to instill confidence in foreign investors, for foreign investors to come in and put their money in China, and how much of a desire that is by Beijing right now.
I think on the whole, it doesn't rank that high for Xi Jinping, to say the least. I think it does rank fairly high for some of the economic officials. And I think some of the measures that Beijing could lay out that provide confidence in the growth outlook, that would help. Unfortunately, I think many of the concerns that foreign investors have really are not about financial sector policy. They're very deep-rooted issues about geopolitical risks, for example, with Taiwan, and about the overall concentration of power in China and the direction that the politics are taking. So not all of that is the kind of thing that can be addressed through a financial conference.
You mentioned local governments and local government debt. That is going to be on the agenda. What is it that foreign investors, that people outside of China don't understand, don't appreciate about how Xi Jinping and his team, his cadre, regard local government debt and control over that local government debt?
I think sometimes what's hard to grasp is how enormous a governance challenge this is for Beijing. It is a vast system. Local governments account for most spending. And, we're talking about provinces that are, many of them, the size of France.
Yeah.
So it's a very difficult center local issue. And sometimes to the outside, that looks as though, China's being kind of foolhardy with what, the approach that they're taking. Now, it's not to say all their decisions are right, but I think behind the scenes, there is a really important kind of political economy context here that's important to understand.
There always is. Michael, thank you so much. Michael Herson is Senior Managing Director and Head of China Research at 22V Research on China's National Financial Work Conference. Coming up, China figures into Caterpillar as well, because Caterpillar reports third quarter results tomorrow morning. We've got a preview coming up with Rob Wertheimer, Melius Director of Research. This is The Close on Bloomberg.
Well, Caterpillar reporting results tomorrow morning with investors looking for any hints of a slowdown in global economic growth. For a preview, we're joined now by Rob Wertheimer. He is Director of Research over at Melius Research. And Rob, I don't need to tell you that given its size, its importance, that we're talking about a bellwether here. And with that in mind, what are you expecting to hear tomorrow morning?
So CAT's actually been executing extremely well the past several years, but especially this past year. And so margins have surprised the upside, and perhaps we see that again this quarter. I think what investors have been focused on, though, is rising interest rates and how that might affect not just the macroeconomy, construction starts and things like that, but also just the willingness of CAT's dealers who are independent to hold inventory. And so I think there's some question as to whether there's a hiccup in the middle of the story. But, broadly speaking, this is a reorientation of how the world works. This is a resumption of CapEx in the industrial world, and CAT is right at the forefront of it. So we expect, generally speaking, pretty good results.
Yeah, I look back to its second quarter results, and it gave blowout results that led to an all-time high for Caterpillar stock, or it was right around that time. But since then, the stock has been kind of a laggard. Give us a sense of the mindset investors are coming into this earnings report with.
Yeah, so I think investors, I mean, maybe this is a market-wide comment, but certainly within industrials and within the space for CAT, have gotten a little bit more cautious around, again, rising interest rates, typically can lead to economic slowdowns. And there's a micro effect, again, with CAT's, channel holding less inventory. And so definitely sentiment has gotten more skeptical over the past several weeks and even past couple of months. So the mood has shifted. There's no question about that.
And something I always wonder about with these names that are obviously tied to the actual physical earth, tied to farming and construction, et cetera, how much do extreme weather events play into the numbers that we could hear tomorrow?
Good question.
It can be an effect in different times and different places, but broadly speaking, not so much. The biggest thing that's happened is bigger than extreme weather, if you want to think about it that way, is just the rise of the IRA, of the CHIPS Act. Your previous guest mentioned Taiwan and the sort of geopolitical risks that have crept in, supply chain risks. All these things are driving investment. And within that, maybe shifts in weather can do that too. But that's what CAT is kind of riding off of, and that's what the world needs companies like CAT to try to solve.
You mentioned earlier that investors as a whole were worried about the higher interest rate environment. Caterpillar has a financing business as well. What is the effect of higher rates going to be on that financing business?
Yeah, so I mean, they do have a financing business, it's a good one, and it tends to finance a lot of what CAT sells. So I don't think it's a idiosyncratic effect for CAT. Their customers will see higher rates, whether offered by CAT or whether offered by a bank, and that's just a form of price increase, one way or the other. Now, the industrial economy, tends to thrive when interest rates are rising. You can't have, low rates means low demand, right? So you can't have high demand without some pressure on rising interest rates. The question is whether there's a tipping point where that really turns negative. Right now, demand has been very good.
And talk to us a little bit about what we might hear from management, because it seems like they don't offer as much guidance as they did before the pandemic. Is that something you've noticed as well? What can we actually hear from them?
No, they certainly have reduced guidance, and they never offered a whole lot of guidance in the first place. Nonetheless, I think if you listen to them last quarter and the quarter before, they were pointing to massive rises in, let's say, the sell-through, the end market demand for their oil and gas equipment. Europe had been and still is heavily reliant on Russian gas, and you're trying to rewire an entire kind of economic energy system for a continent. Some of that, uses CAT equipment for gas pipelines and other things, including construction. And so they do give commentary on where their end markets lie. You also have the infrastructure bill, which is, long since passed, but not yet kicked in. And that should kick in 24 and maybe 25. So you hope to hear a little bit from management how their customers, their dealers, and their end customers are thinking about investing ahead of those, rising demand trends and where it's going. And finally, we've seen copper fall. I mean, there's, the China commentary is dead on. China's been very weak, and that's been a driver of global materials prices for a long time. So does that make mines hesitate, or is the massive investment needed for energy transition the predominant force, and is CapEx and mines rising? So those sort of things I think we'll hear from CAT tomorrow.
All right, Rob, thank you so much for giving us a preview there of Caterpillar, which will report results tomorrow morning. We'll be all over it, of course, when those cross. Rob Wertheimer of Melius Research. Now, according to a report in the Wall Street Journal, the University of Michigan has rescinded a new contract offer for head football coach Jim Harbaugh. It comes in the wake of a sign-stealing scandal that rocked one of college football's top teams. Harbaugh now saying that report is inaccurate. So joining us now to give us a sense of what the legal implications of all of this is Steve Olenek. He is sports and entertainment practice chair at Mintz, Levin, Cohn, Ferris, Glovsky, and Popeo. Did I get all of them in there?
Got them all in there. Got it all in there.
Steve, thanks for joining us today. Jim Harbaugh has been an incredible coach for Michigan. Of course, before that, for other schools, and before that in the NFL as well. Is Michigan going to do something about this? He's had such success with the Wolverines.
Oh, he's had great success. Like you said, 49ers, Stanford. Everywhere he's been, there's been great success. One of the main issues here, though, there's a lot of baggage going on here. There's an FBI investigation. There's the sign stealing potential investigation, what they're looking at, what they're not looking at. And of course now, surprisingly, the Michigan Wolverines are 8-0, potentially going into the college football playoffs, potentially winning a national championship. So we have a lot of variables going on, especially with the university, the president, the athletic department. What are they really going to do?
I can't see the alumni letting this happen. I mean, and Michigan has a very devoted alumni fan base. They're going to press on the athletic department and on the university to wait until the season's over before looking further into this.
100%. And with the NCAA, they're under the bylaws, they have a fiduciary, the role of the head coach, right? So it's 11.1.1.1. The buck stops with the head coach.
So he's responsible for everything.
100%. So you have to know what people are doing. You have to know what your coaches are doing, how you're getting the information, what you're doing with it. So Mr. Harbaugh right now, he is of course going to plausibly deny everything right now. But like I said, the reason is because he's going to play for that college football championship.
Steve, I don't know if you've picked up on the fact I'm not a college football person, so I'm learning a lot here. And I guess my natural question would be, what could he do here, Harbaugh? Could he potentially sue the university, or how do you see this playing out?
I mean, right now he's, just do nothing, right? Have the investigation, kind of keep pushing it down the field, as you would say, no pun intended. Oh, God. Keep pushing it down. But at the end of the day, I think what you're going to do, you're just going to right now have the investigation go on, see what's there, do some fact finding, work with the university. But at the same time, you got a football game to play, right?
Got a football game to play. So we'll let it play out, but stepping into hypothetical land, where could he go from here? Would he go to another college team, or could he potentially return to the NFL after this?
Oh, I think look, the NFL is all about wins and losses. He had great success, 2011 to 2014, great stint with the 49ers. I think he could jump. There's a lot of opportunities in the NFL where a lot of these guys are evaluated based off wins and losses.
Yeah.
So I think Coach Harbaugh would have a lot of opportunities.
You represent a lot of athletes and folks in the sports world. Is it better to be a coach in the NFL or for a big college football team?
Well, I think it's great to be a coach all over.
But in terms of the contract, in terms of what you can get,
They're all of it. I mean, that's a great question, but they're all guaranteed money. So in terms of it, what you really care about is that good old-fashioned definition of cause, right? Because then you're going to determine whether it actually is guaranteed and when you tripped it up, and whether the morals clause will actually allow you to potentially get out of the contract. So it's going to be a very interesting time in college sports.
Okay, I'm glad you bring up the morals clause because we don't know what kind of what the language is in the contract that Jim Harbaugh has right now. Right. What if you were representing him, or any football coach for that matter, how would you write the clause so that it's in your client's favor?
Very narrow, very narrow. So it's got to be a trip up, say stuff of something that he can control, right? This particular instance, he can't really control, right? Because it could have been through another coach.
We're talking about the sign stealing part of it.
Right.
Yeah.
And so with that, the buck comes back to him. But if you actually have that morals clause narrowly drafted, he could say, hey, look, I didn't do it. And so at the end of the day, they'd say, well, it'd be very hard to trip it up and have a lawsuit tied to cause. So it'd be very narrowly focused.
And the schools would be okay with that, you think? In their quest to make sure that they sign this winning football coach at all costs, right?
Depends on how bad they want to win the championship.
That's what it always comes back to. Steve, thank you so much. Steve Olenek, Sports and Entertainment Practice Chair at Mintz, Levin, Cohn, Ferris, Glovsky, and Papeo. Got him, right? All right, still ahead. What investors need to watch for tomorrow. Tuesday's coming up, and we've got you all covered. This is Bloomberg.
Season is here.
Tons going on, lots of earnings.
Beat wherever you look.
Bloomberg breaks the numbers first.
It's a tale of two earnings. Results from Goldman Sachs, Bank of America, and Morgan Stanley.
Netflix is out, guys.
With exclusive expert analysis.
Recovery is underway.
They crushed it. It was one of their best quarters ever.
This is a story all about pricing power.
We're going to make more money. We're going to make more money. And we're going to make more money. We're making bank. And I think that is what we can take away.
Bloomberg Television and Radio. Context changes everything.
All right, Monday is in the books. It was an update for U.S. equities. Let's look ahead to tomorrow, and a lot of it's going to be driven by central bank action overseas.
A lot to look forward to. Of course, we have the Bank of Japan's rate decision, comments on yield curve control coming out. We got a little bit of a preview, of course, Japanese press reporting that the BOJ considering letting yields, 10-year yields, rise above that 1% target cause a reaction in U.S. markets.
And it certainly caused a reaction in the Japanese yen as well. That currency strengthening after hovering around 150 for a while. There's a lot of speculation that Japan, the authorities, would step in and support the currency. And of course, staying overseas, we've also got GDP and CPI data out of Europe.
Out of the Eurozone, it's going to be interesting to see that. A little something to get excited about before we get to some of the big earnings that we're going to have stateside. Talking about Caterpillar, Goodyear, et cetera, JetBlue as well. And that's just before the bell.
That's just before the bell. After the bell, we're going to be here taking you through those numbers when they cross. They include Chesapeake, Match, Advanced Micro Devices, Yum China as well.
It's also Halloween.
Yes.
That's what I'm very excited about. That should be a lot of fun.
Check out what Katie's going to wear tomorrow. It'll be appropriate for the holiday, right?
It'll be tasteful.
Okay. That does it for us. Balance of Power is up next.
Have a great evening. This is Bloomberg.